It's 9 a.m. here in New York City. I'm Madison Mills alongside Brad Smith. This is Yahoo Finance's flagship show, The Morning Brief.
Good morning, everyone. Stock futures mostly flat this morning after the Dow hit its 24th record close of the year Tuesday. So let's get to it with the three things that you need to start your trading day. Yahoo Finance's Dan Halley, Jared Blickery, and Brooke DePalma have more.
Wall Street is bracing for Nvidia's second quarter earnings report after the bell. The stock is up 160% this year and is seen as the bellwether for the AI trade. Option markets are pricing in a $300 billion swing for the stock in either direction. And we can expect to see ripple effects throughout the tech sector and the broader markets. For the quarter, Nvidia is expected to post a 139% jump in profits and a 113% increase in revenue compared to a year ago. Investors are also hoping to get clarity on any potential shipping delays in Nvidia's Blackwell chips.
And cryptocurrencies are falling across the board today. Bitcoin is tracking just over the $60,000 price range. At one point this morning, we saw it below $59,000. Ether and Solana are also both falling. Now, cryptocurrencies originally rose on the Fed's dovish signal at the Jackson Hole event last week that the central bank is prepared to cut benchmark interest rates, which sit at 23-year highs. But we're also seeing that bump in digital currencies unwind a little bit.
And a slew of retail reports this morning painting a mixed picture of the health of the U.S. consumer. We heard from Kohl's, Abercrombie & Fitch, and Foot Locker. Kohl's bucking the trend, shares climbing after the retailer raised its full-year outlook after focusing on inventory levels, but the company did lower full-year sales growth guidance. The CEO there citing a consumer that is showing ongoing discretion with their dollars. Abercrombie & Fitch shares are falling this morning. While the company boosted its full-year margin guidance, the street was looking for more. The CEO also citing an increasingly uncertain environment. And Foot Locker, the sneaker giant, falling in pre-market trading, but it did achieve comparable sales growth for the first time in 6 quarters. The stock still down as its turnaround efforts, what they're calling Plan Lace Up, failed to impress Wall Street with store closures announced in both Asia and Europe.
Our top story today, Nvidia's make or break earnings. Get that countdown clock fired up. We're just 7 hours away from the highly anticipated report. We've got the team coverage to kick us off. Our tech editor, Dan Halley, is standing by. We'll get there. But first, Maddie, of course, why do we care so much about this report? It's not just about this company. It could define the entire market as well.
That's exactly right, Brad. And remember that Nvidia makes up over 6% of the S&P 500. You can take a look here at the comparison level, right? This blue line is your S&P, and the purple is Nvidia here. So you can take a look at Nvidia's power over this market as this chart shows how many times Nvidia has been responsible for a 1% rolling weekly gain in the broader market. And you can see here since its October lows, this line has gotten bigger and bigger. That is showing us Nvidia's power over the broader market and how it's grown alongside Nvidia's market cap.
That's right. And that power makes sense when you look at Nvidia's year-over-year earnings growth coming in at 461% in their last report in May. But you can see that that growth number could decelerate in the company's future estimates. That's what's anticipated. So is that going to present a problem for a market that's been so steadily relying on what this AI poster child and chip company has to say, which contributes to those broader gains that we've seen as well. So for more team coverage, let's bring in Dan Halley to break down the 3 key things that traders need to watch out for in this report. Hey, Dan.
Yeah, guys, today is the day. And let's just say there's plenty of hype for Nvidia's earnings this quarter. The first thing investors will be looking out for is the chipmaker's all-important data center business, which is critical to the company's AI development. Nvidia is expected to bring in $24 billion in revenue, a 142% increase from the $10.3 billion the segment saw in the same quarter last year. Wall Street is expecting Nvidia to not only beat its Q2 expectations, but to raise its guidance for the following quarter as well. Second, investors will need to look out for big updates on chip demand. Nvidia is the world leader in AI chip design and software, controlling between 80% and 95% of the market. That's according to Reuters. And it's expected to continue to hold that lead as it begins rolling out its next generation Blackwell line of chips. Wall Street will be looking for updates on any potential delays in Blackwell shipments, but analysts at firms like Goldman Sachs, KeyBank, and Loop Capital don't see that as much of a concern for Nvidia in the near term. And lastly, watch out for any signs of spending. Investors see the chipmaker as a key barometer for AI investment demand, so they'll want to hear from CEO Jensen Huang on the earnings call that the company is pouring more money into its AI chips.
All right. Great insight, Dan. Thanks so much. We know that you're going to be sitting on the edge of your ergonomic chair once those earnings cross, but until then, let's stick with this conversation on Nvidia. Wall Street has lofty expectations here for the chipmaker, expecting earnings growth of over 100% year over year, revenue growth of about 99% year over year. The Mag 7 heavyweight set to announce its latest results with 66 buy ratings on the street and with its shares up over 160% this year. But enter our next guest saying, hold my beer, isn't sold on all the hype. David Bahnsen is Chief Investment Officer over at the Bahnsen Group, here to tell us why now might be the time to explore other investment options. All right, why the cold water here?
Well, the notion of the earnings growing 100% year over year was projected a year ago, 9 months ago, 6 months ago, and 3 months ago. That's all been known and priced into the very high multiple at that time. There's absolutely no question that the company has performed remarkably well and that the outstanding financial metrics of revenue growth and earnings growth have been noteworthy. The question is entirely for people buying the stock, whether or not that's priced in. Are they paying for a company that already has that known? And it's very obviously known because 66 analysts have said so, and we're sitting here talking about it now. 70 times earnings with 100% earnings growth priced in. There's absolutely no margin for error. And on a go-forward basis, there's no doubt that there will end up being some snafus, some revenue hiccup, some margin compression.
But what?
That will throw a lot of water on this party.
Where do you think that's going to be derivative of? Because, I mean, otherwise, as of right now, we could have said these are going to be tough comps to continue to try and deliver to the street 3 quarters ago.
Well, 3 quarters ago, there wouldn't have been much of a reason to think that was imminent. The issue is entirely about the appetite from the investing public to pay up for it. That part I couldn't time and couldn't dare to guess. I think the analogy here to 1999 Cisco is almost perfect because Cisco never did run into a snafu. There never was a point at which revenue tanked, earnings tanked. They performed remarkably well. Problem is, 25 years later, the stock is still nowhere near where it was in that bubble valuation. Nvidia faces the same thing. They're going to perform very well. It's just you're paying 70 times earnings for it.
So when is the right time for investors to sell this stock?
About a month ago, 2 months ago, today, tomorrow. They don't have to sell all of it. My position is just simply for us as more value-oriented investors and dividend growth investors to just simply point out that people are paying for perfection. And what the investment thesis is at this point has nothing to do with Nvidia. It has to do with other investors. You're buying Nvidia, banking on there being another investor who's a bigger sucker than you are. It's called greater fool theory. That can go on for a long time. People can make a lot of money doing that. I just am not any good at it, and I don't think very many people are either. But that's really what the investment thesis in Nvidia is right now, is praying that someone else will pay up more than you do.
What's tough for me about your thesis, David, is that the math is so there for Nvidia. I want to take a listen to something that Sundar Pichai of Microsoft said over the past couple of months with regards to Microsoft's expenditure on AI and get your response to it.
No, I think the one way I think about it is when you go through a curve like this, the risk of underinvesting is dramatically greater than the risk of overinvesting for us here.
So Microsoft and some of the other hyperscalers make up 40% of NVIDIA's revenue. If we are continuing to hear from those executives that they're increasing CapEx on AI, which right now means NVIDIA because there's not enough competition, how can you maintain a bearish stance?
That's why I maintain a bearish stance. That's one of the most bearish things I've ever heard. 40% is from one or two companies. And how has Microsoft done over the last 4 to 6 weeks? But it's the biggest companies in the world,
and they're going to continue to
Microsoft
spend.
just got done saying that they are lowering those expenditures going forward. What you have right now is a vicious cycle where Microsoft is going up because they're buying a lot from Nvidia, and Nvidia is going up because Microsoft's buying a lot from them. It doesn't seem like a particularly logical conclusion that they can both feed off each other that way in perpetuity. When the market decides that that system is unsustainable, I have no idea. I wouldn't dare try to time it. But the idea that there is, without this great return on that invested capital, Microsoft will continue growing those expenditures quarter over quarter. All one has to do is look at Microsoft's call from 5 weeks ago, and they can see that there is no possibility that that's going to continue.
That was not my takeaway from Sundar's soundbite there, but putting that aside, can you tell me something in the math and the numbers that tells you that there's a bearish story being ignored by the market for Nvidia?
Yes, it's called the multiple. It's called the PE ratio. That's the math. 70 times earnings. It doesn't end well. History is our guide here.
Even if you have Nvidia able to grow into the multiples that the market has assessed, how long do you believe that would take from your estimation?
Well, for them to do that, let's be clear, at a $3 trillion market cap, that they have to grow the size of the entire 7-Eleven company to go up 1%. 1%. For this to continue just based on organic growth, they have to now move the needle by hundreds of billions of dollars to get just a basic market return. And so that's the problem. This is not me bashing on Nvidia. This is a success story. I'm commenting on the valuation, that when you start paying to those prices, the risk-reward skew becomes very unattractive. But the fundamentals of revenues and earnings are not the problem. The problem is that that's already priced in and known by everybody. And obviously, the analysts on the street are not going to get caught with a sell or hold rating on Nvidia. It's very bad career risk for them. So for an investor to want to hold a small piece of it and pray that a 70 times company goes to 80 times, they could do that. And I don't think they're going to get hurt real badly to make it a small piece of their portfolio. But as you pointed out earlier, it's 6% of the index. Tech has become 31% of the index, and with communication services, 40% of the index. It's more top weighted than it was in 1999. It's not going to hold.
I appreciate that you've got the stomach for it, David, when the rest of the street doesn't necessarily. But we got to end on a stock that you are a little bit more positive about, and that is Broadcom. I want to look at a chart here showing the EPS contribution of Nvidia versus Broadcom on our screen. And there you can see the difference in the stock performance, with Nvidia soaring above Broadcom in terms of the fundamentals here. That's some data from strategists. But I'm curious how you maintain the bullish perspective on Broadcom, given that Nvidia is already taking up so much space in the room.
Well, Broadcom to me is not about the AI chip story. It happens to be up about 500% since we bought it, largely because of AI, but it's a free cash flow growth story. It's a very low weighting for us now. Like I said, we've made 500% on it. And Broadcom was not an AI chip maker prior to this story as much as a kind of roll-up of a whole lot of different names in the manufacturing side of semis, and they're a dividend grower. Because the stock has grown so much, the yield has gotten to be very low, so we maintain a very low weighting, and we're waiting to see what they do with dividend policy going forward. Nvidia has managed to pay out a 0.4% dividend yield with one of the most profitable companies in human history. Ultimately, all of these big tech companies that have grown through the sky, Broadcom's returns kind of speak for themselves. They end up having to return cash to shareholders, or they set money on fire.
Yeah, it's interesting, especially coming off of their most recent earnings call, Broadcom talking about as the strong demand from hyperscalers for both AI networking and custom accelerators. It's interesting to note that as that AI data center clusters continue to deploy, their revenue mix is actually shifting even more towards an increasing proportion of networking. So we'll see what they continue to put forward and communicate to the street here. David Bahnsen, who is the Chief Investment Officer at the Bahnsen Group, we know you'll be paying close attention to those earnings later on today from Nvidia as well. Thanks so much.
Thank you.
Certainly. Let's get to retail here. The retail sector painting a mixed picture of the consumer yet again this morning. We've got a tale of 3 different retail reports we heard from Kohl's, Abercrombie & Fitch, and Foot Locker, all telling us their own stories here. So let's start with Kohl's, a mostly positive picture from the department store, the company beating earnings but missing on revenue, but that higher outlook for EPS sending shares higher. We got to bring in Yahoo Finance's Brooke DePalma for more details on this. Hey, Brooke.
Yeah, good morning to you both. Certainly that outlook, that raised forecast on profit is certainly weighing and exciting Wall Street this morning. In pre-market trading, the shares were even higher. And the company now saying that they expect operating margin to come in between 3.4% to 3.8%. That's higher than the previous quarter outlook that they had set. Diluted EPS expected to come in between $1.75 and $2.25. Now the call is underway. The CEO there saying that although they're disappointed with their second quarter sales, which fell 5.1%, they continue to execute well operationally, enabling us to deliver a 13% increase in earnings this quarter, driven by gross margin expansion and strong inventory and expense management. That then giving the confidence once again to raise its annual profit forecast, and that really exciting the street this morning. But the company did share that it still is seeing a consumer that is very discerning with their dollars, really focusing on where exactly they're spending, and that then caused them to change their 2024 outlook. They now expect comp sales to come in down 3 to 5%. That's lower than what they previously had set out at the first year. But guys, one thing to point out in this report is that ongoing push that they're making with Sephora stores, that continues to do well for them. Total Sephora Kohl's sales increased approximately 45% in Q2. And now they have more than 1,000 Sephoras at Kohl's store. That business trending well for them.
Well, it's interesting, Brooke, hearing you talk about some of the consumer weakness they cited, because that was a key sticking point of another retailer. I know you were on the call for Abercrombie listening in this morning. What did we hear about those results and why they weren't enough to lead to a positive stock reaction?
Yeah, reading around the room this morning, it seems like what analysts are saying that this reaction was really people, investors buying on the rumor, selling on the news. Abercrombie did well, but Wall Street really wanted more. Abercrombie was a key competitive story this past year, one to watch as they really turned the tides. And now investors really weighing in on inventory levels, on promotions, heading into the holiday season, really looking for how exactly this company will perform this holiday season in this environment where they are also citing a challenging consumer as well.
Yeah, it's interesting. As we go from apparel all the way down to the footwear that we're wearing as well. I was tracking Foot Locker here this morning, and in my extensive 16 pages of notes here, I was trying to find my notes, and I summarized it into just about 3 lines here within this. One, the gross margin guidance was, and that range was lowered here, so that's something that investors perhaps, as we're seeing shares move lower pre-market for Foot Locker, that could be one of the things that they're really snacking on, waiting to get a little bit more color, or getting a little bit more color on the call this morning, even as shares are down 8% right now. Also here, the losses just barely widened year over year. If you look at that adjusted EPS here, that's something as the company is going to continue to communicate to the street that they're seeing some stabilization in certain parts of the business. It's a larger question of stabilization at what cost? How many different stores do they need to close? Oh yeah, that was the last thing I put down in my notes. The fact that in different regions, this company is internationally at least sunsetting some of those operations. That's something that you flagged as well this morning, Brooke.
Yeah, they did point out in the call. In Europe, they closed our Runners Point and Sidestep banners, and in Asia, they converted our operations in Singapore and Malaysia to a licensed model. Mm-hmm. It seems like investors really closing in on that and wondering if this lace-up plan is working, when they'll see the fruition of that.
The other thing too, and I didn't write this in my notes, but it just kind of a photographic memory popped into my head. Heavy promotion, heavy discounting is actually one of the things that's going to impact those gross margins going forward from here. And they talked about that within the release, and I imagine giving a little bit more color on the call here. A consumer already that is strapped and looking for value hacks as well. This was evidenced in where they were going to some of the off-brand or even some of the discount retailers as well. You saw TJX do very well this most recent quarter. I think that's where, even going into the latter end or latter portion as we are in that of this year, consumers are going to continue to look for those discounts, look for those deals, and that's where Foot Locker might have to continue to put more promotions into the market here as well, even ahead of a very deep discounting season in the holidays as well here.
Yeah, you see a Walmart continuing to do well in this sort of environment, and you have to wonder how these specialty retailers will make out.
Yeah.
Right, and especially with Target cutting prices on 5,000 items over the past couple of months here. So certainly seeing those price cuts across the board, leading to some changes when it comes to the earnings side of things. Brooke, thank you as always for bringing us your reporting. We really appreciate it. Our own Brooke DePalma. Let's take a look at cryptocurrencies, seeing their biggest drop since the market sell-off earlier this month. The world's largest token, Bitcoin, dipping below the $60,000 mark, and the second largest, Ether, falling as much as 7%. Here with more, we've got our own crypto expert, Jared Blickery, joining us at the big board. Hey, Jared.
Hey there, you set me up like that. I wish I had a better explanation. Let me just show you what's happened over the last 3 days. So kind of humming along here, just sideways to down. And now we got that big plunge and kind of a reaction off the bottom here. And that's just more of the same from cryptocurrencies. We see a lot of the price action a lot of the time is, unfortunately, it is random. So here's what's happened this year. And what I'm going to point out here, and you can draw these lines a few different ways, but basically we're going in a flag and it's actually pointing down. So the short to medium term trend has been down this year, but nevertheless, the longer term one is still intact. This is still a bull market in crypto on the longer time frames, but there's a lot of activity here. And you got to imagine when it finally breaks this trading range, has a ways to go either up or down to do that, it's going to mean something for the market and probably get follow through. Let me just show you what all these guys are doing over the last month. So it looks more bearish than not. You see Ethereum down 22%, and there's no big catalyst on the horizon though, but we are looking at the Chang hard fork in Cardano. That's now set for September 1st, guys.
All right, Jared, and later on in our 10 a.m. hour, we're going to be speaking with the CEO of an ETF that tracks a lot of the Bitcoin names, so we'll be able to get a little bit more color on that, so stick around with us. But for now, we're taking a look at Yahoo Finance's trending tickers, so stick with us after the break for more.
Let's take a look at some trending tickers here this morning. Nordstrom shares, they are falling right now slightly by about 0.2%. The department store, it topped its second quarter earnings estimates, raised full year guidance. The retailer also seeing strength from its off-price brand, Nordstrom Rack. Stop me if you've heard us talk about how strong off-price has been and discounted, or at least some of the homegrown brands have been this quarter for companies in retail.
It's such a good point, Brad, because last quarter when we were talking about Nordstrom, part of the story, at least from the analysts, was this idea that the company was cannibalizing itself with Nordstrom Rack, taking away some market share as consumers were buckling under the weight of inflation and looking for some of those cost-cutting measures at some lower-priced retail options. Now, the analysts are saying it's actually the opposite, that Nordstrom Rack is a positive because the company is finding ways to increase the amount of capital they can bring in from those discount retailers moving forward here. And that is why we were seeing a positive reaction on this stock. But as you can see on your screen, it's certainly been under pressure over the past couple of months here. But year to date, it's still up nearly 15%. So good year to date story for Nordstrom, but interesting to see what the kind of catalyst will be moving forward, if they'll be able to continue that growth on Nordstrom Rack.
It might be the digital business, honestly. Yeah. And that's something that they talked about on the call. The momentum in their digital business continued with net sales growth of 6% here. They also mentioned that their teams executed well on that vision. They had a big anniversary sale, but
yeah,
I mean,
it's
been a summer of sales. I mean, everybody feels like they've been throwing out, all the retailers have been throwing out their competitor to Prime Day, or at least saying, all right, if that's when Prime Day is, we're going to throw some deals out there as well, because they know that there will be people online comparison shopping, which has really been the boon to some of these digital sales results that we've seen as a subset of the overall revenues and sales figures that have come out from retailers this quarter.
And to your point, strong marketing for that anniversary sale that led to a better sale this time around than we've seen previously from Nordstrom. But we got another stock we're looking at. Chewy shares are surging here, up over 1.5% after their earnings coming out this morning. They were up about 3.8% in the pre-market, but this is that online pet food product retailer coming in with earnings announcing better than expected second quarter results, even as the number of active customers dropped nearly 2% year over year. Chewy noting that even with the drop, active customer engagement is still on the rise. The company is saying net sales per active customer hit a new record at $565 in the last quarter. Now, this is a fascinating one because the valuation continues to be a debate, and that's what we're seeing in some of the analyst commentary already from the likes of RBC Capital Markets here. But that active customer growth was a really positive move to the upside for this stock, particularly as inflation is starting to come in. And I think it's fascinating that they noted that in some of the reporting today. This idea that as inflation in the pet sector is starting to move down just a little bit and take the pressure off, that is a positive catalyst for a stock like this. It's good news for the Fed. It's also pointing to this broader picture that we've been talking about price cuts. And I wonder how long it's going to take for that to show up in the headline data even more clearly when it comes to retail inflation moving forward.
Yeah, the amount that they're able to get from their active customers and that sequential growth that you were talking about as well, that's also passing into, or at least contributing to some of the better gross margins that they are seeing too. The company saw gross margins of 29.5%. That increased about 120 basis points, so about 1.2% year over year. And that is something that perhaps we'll hear a little bit more from them about. But they said this was essentially another strong quarter for the company here. Sumit Singh, who's the chief executive officer over at the company, saying that they've got a more compelling value proposition, and that's what's really bolstering some of this deeper customer engagement right now. People got to take care of your pets out there, so just, make sure, I don't know.
Make sure you keep taking
care of your pets.
Yeah,
yep, that's the t-shirt. That's it. Take care of your pets. All right, let's talk about this other company that actually plays in the pet space as well here. JM Smucker shares are under pressure. The company beating fiscal first quarter profit estimates, but slashing its full year profit guidance here. Smucker saying it expects inflationary pressures plus lower discretionary spending to affect its pet snacks and baked goods categories here. Take a look at shares right now. They're down by about 3.94%. Good Orville, Ohio company. If you haven't gotten out there to the mecca of jellies, jams, butters, and all the spreads.
You've been there, Brad.
I have.
Tell us everything.
Indeed. We have a limited amount of time, but from what I will tell you here, in this most recent quarter, it's really evident that this company is going to lean more into its Hostess Brands acquisition. You think about as well how they've also ramped up separately in some of the frozen and handheld snacks category. The Uncrustables really falls within that, and I think that's where they're going to have a little bit more of the operational execution as a result of some investments that they made over the last 18 months that are starting to pay dividends now and come to fruition. Of course, we're seeing shares move lower here today, but it'll be interesting to see what Mark Smucker, who has been here on Yahoo Finance before, what he says more and offering a little bit more color. But ultimately, he's pleased with the strong start of their fiscal year right now.
Yeah, it's interesting because some of it was priced in to a degree. That's what the response has been from Citibank, saying that the reduced outlook for Hostess in particular was probably not too surprising. But what did seem to take the street by surprise initially here is that sales and EPS guidance that you mentioned, moving to the downside a little bit. That was not necessarily precedented for this stock this quarter, but it's not unprecedented for SJM more broadly when we look at their history here. And to your point, Uncrustables, volumes soaring, keeping things up for them today.
So tasty.
So tasty. Having said that, let's get to that opening bell. You're hearing it right now. And let's do a check of the markets here. Taking a look at the major indices, you've still got movement to the downside with the S&P 500 and the Nasdaq actually flipping into positive territory. It's up about 0.1%, but the Dow hovering just around that flat line still here, Brad.
Let's get on over to Yahoo Finance's Jared Blickery for more at What's Moving. He's standing by at the Yahoo Finance Jumbotron. I don't know, we're still trying to brand it, Jared, or at least I'm trying to make Jumbotron work like Gretchen trying to make Fetch work. But anyway, over to you.
I like the big. Let's take a look at the Dow. It looks like just maybe a continuation of yesterday. I think that is yesterday's return, so maybe we haven't gotten that first quote yet. But I'll take a look at the S&P 500. That is just barely underwater. And what's striking about the recent action in the market is just that it's been low volatility, low volume, and it's kind of what you want to see in a very big holiday week when you don't have all that big liquidity in the market. So I'm taking that as bullish, but you do want to be on alert for the potential of a big drop just because you don't have that liquidity there. So here's the S&P 500 year to date, and clearly we're tracing out this pattern here. A lot of people are going to be looking for a potential M top, but that's not necessarily in the cards just yet. These things take time to play out, and we're just in the beginning stages. I want to take a look at the VIX right here. You can see that is settled. That's actually the VVIX. Let's see if I have the VIX. That's at a 15 handle, 15.65. And let's take a look at the sector action for today. We have utilities in the pole position, but that's just a meager amount, 0.2%. To the downside, we have energy leading the way down. And I did want to take a look at futures. We have had gold kind of notching record highs recently. It doesn't look like we have it in the cards today, but here's the year-to-date chart, and up 23%. That is outperforming the Nasdaq 100, and so very impressive to see commodities, at least this precious metal, participate in these rallies.
Gold, Jared, gold.
Yes.
That's what you are, and that's what that chart is. Thank you so much. Appreciate it. Coming up, everyone, we push ahead to the all-important earnings after the bell. Nvidia, stay tuned. You're watching The Morning Brief. AI giant Nvidia set to report results today after posting a 160% rally so far this year. Our next guest says investors will continue to be bullish on AI, but are broadening out from the infrastructure-driven plays. Joining us now, here in studio, we've got Kate El-Hilo, who is the president and CIO of Russell Investments, which oversees more than $300 billion in assets under management. Great to have you here on set with us.
Great to be here.
Absolutely. So let's dive into this. I mean, the expectations going into this report, very high, but where are we seeing some broadening out in the mindsets of investors right now?
Yeah, and so you made the point, like, Nvidia at 7% almost of the S&P. It's 10% swing either way in terms of these earnings coming out, and so we're all focused on that. But the broadening out, like, into the powering of AI beyond just the infrastructure and the hardware, but then the application of it into different sectors is where, as we're talking to some of the managers that we work with and within our team, like, it's in the consumer areas, it's in the service areas where you can start to see it actually being applied. It's going to take longer for that to play out versus what we've seen with this hardware investment, all the CapEx spend that's been happening, but it hasn't been priced in yet. So we do see more of an opportunity there, and that's where people are starting to make some shifts.
How are the folks on your teams finding the right opportunities that aren't the headline plays?
Yeah, I mean, it's going into really thinking through, like, not just the large language model and kind of the big expensive ways to do this, but some of the efficiency plays or the ways just to make the client acquisition of so acquiring clients or accessing clients more efficient. We think it'll start to get into more of the how do you drive more revenue from it, but I think the first plays are going to be around how do you just do things more efficiently and access clients more efficiently.
When we think about the cutting cycle that's set to emerge and set to begin from the Fed here, tech typically during cutting cycles, one of the beneficiaries here, I mean, could that potentially be a little bit of a, maybe not a full-on balloon for the tech giant or for some of the tech sector here, but I mean, maybe just like a little bouncy house for them to find some stability in?
Yeah, I think that you're starting to see, through the volatility that we had during the summer and some of the mixed messages and news that was coming out, the monetary policy easing story taking hold, a little bit more conviction, I think is giving the market the ability to focus on the tech players, understand that maybe trim some of the winners, maybe start to pull back a bit and take advantage of that, but really look into maybe some of the cyclicals or some of the value stocks that will do better as the monetary policy easing story takes hold. And so we do expect to see some volatility in action, but that broadening out again. And that story goes well beyond AI into kind of value and cyclicals, maybe even the banks. As you start to see, as policy rates start to come down, borrowing starts to become a little bit easier to support. So again, we do see that there's some support there, and that's one of the trends that we have managers and our team talking about.
And as we continue to talk about the rotation and the opportunities outside of tech, how might the earnings report we're getting in 7-ish hours here impact that? Like, is that a convenient narrative while we all waited for Nvidia earnings, and if they blow it out of the water, we're back in all focused on AI?
I think it gives you more conviction around the broadening out. If you know that there's still spending happening from a CapEx perspective, and people are trying to build out the infrastructure to do this, you feel more confidence that the only reason you're going to be doing that is because you see opportunity in terms of buyers on their end starting to invest more. So I do think it ends up giving that next push into a broadening of the rally.
We were talking a lot about consumers and what we're seeing in some of the retail reports that we've gotten out this morning, and kind of lends a larger question to what the state of the consumers means for the rest of this market here, those that are most sensitive to where consumers are looking for more value hacks, where they are being a little bit more battle weary because of inflation as well right now. What are you sensing there?
Yeah, I think that people are being more discerning about where they're spending. They're looking for the the higher value kind of opportunity for sure. But even things like going back to school, like there's still spending that's happening. The consumer's not yet weary. You still have maybe the divergence between mid to higher income versus lower income, but most of the consumer names are actually doing well, and it is more in the value part of their operations. But that's a positive. Where you may have seen some slip ups is where there's maybe more exposure to China, and so you saw like whether it's Estee or Nike, et cetera. But in terms of the U.S. consumer, you're still seeing the spending happening, maybe just a little bit more carefully.
And that makes me think about the next big thing for markets this week. Once we get past today, it feels like PCE is the next big one coming up on Friday for inflation data purposes.
Yeah.
Will we continue to see market moves as intensely off of inflation data, or is really the focus the labor market?
I think it really is non-farm next week more than, I don't say you're going to fly by PCE, but I do think it's going to be probably a continued drop down. You go in to see kind of what's really driving it, but it really is the labor market and whether you start to see any shift in layoffs in particular, because it hasn't been part of the story. And so as long as you start to see maybe a normalization of the labor market, but not any kind of increase in layoffs, I think you're still going to see this rally continue and some broadening out.
And real quick, what do you think we're going to see on the 6th? Strength or weakness?
No, I think it's going to still be strength. I mean, if you get to that on the average, even after adjustments, 176,000 over the last 12 months, that is still very strong labor market. So even if you're in kind of the 140, 150 range, that still is fine. That still is. We're still creating jobs, and it's still above kind of the average pre-pandemic.
All right, Kate. Great stuff as always. Really appreciate you coming in studio with us. Thank you so much. Kate Elhillo of Russell Investments joining us in studio. Coming up, we'll continue to have all of your markets action ahead, so stay tuned for more. You're watching The Morning Brief.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
and expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
Retail sector painting a mixed picture of the consumer over the last few weeks. Strong July retail sales pointed to consumer resilience amid sticky inflation, but some companies have pointed to a choosier customer trading down when they can as a result of higher prices. Yahoo Finance spoke with a number of people that reflected the mixed picture.
The consumer is still hanging in there.
I think the consumer is doing fine.
There's a lot of strength there that the consumer is showing.
We see a consumer that is willing and able to spend, but they may or may not. And that's really manifesting in a choppy environment. The consumer is still definitely feeling inflation.
I think it's the right tone to be cautious in the context of where the consumers are navigating.
I don't think that I'm as optimistic about the future of the retail economy and the consumer attitudes as maybe the market seems to suggest. The consumer is really, really softening.
Here to weigh in, we've got CFRA analyst Zachary Waring. Zachary, thank you so much for joining us. So obviously you could hear from so many of the executives and analysts who've come on our program, not a lot of agreement when it comes to their headline on the strength of the consumer. Help us find some clarity. What do you think?
Yeah, thanks for having me. So, we think the consumer's just being picky here. It's a stable consumer, but we wouldn't say they're strong by any means. I think over the last 12 months, it's continued to trend down slowly, but, we think that's just a picky consumer right now.
Okay, and so one common thread seems to be the consumer right now focusing on value. And we were discussing this earlier in our show, and, just want to play this quick clip for you here and get your reaction on the other side.
The real key to success in retail is value. Consumers want a deal. They look for promotions.
Consumers are extremely value oriented. They are shopping at the discounters, off-price retailers.
The consumer, as they migrate a little bit more towards value.
They're being choiceful, they're being discerning, they're looking for value.
So if there is one retailer that is doing well and outperforming others on delivering value, who from your purview is it right now?
Yeah, so, we think that there is the off-price retailers and value retailers are definitely doing well. So you've got TJ Maxx and Ross stores who, they continue to, share price appreciation, and earnings and store growth. So we think they're really well positioned. Outside of that, I think there are brands within apparel and footwear that are showing that they're able to grow. So you had Abercrombie this morning. We actually just upgraded the shares. They continue to show that they're able to grow not only revenues, but their margins are expanding pretty rapidly. So we do think there are definitely, apparel brands that have been able to grow through this macro backdrop.
What do you make of the street's reaction to Abercrombie earnings this morning? There was a lot to like in the report, but the shares were down. Wow, they're down now over 14%, earlier down 10%. What do you make of that reaction?
Yeah, and we think investors might be a little bit scared that this, could be peak growth for them. But we think there's other catalysts for the shares moving forward. We really think the company has now got a clean balance sheet. They have no debt. So they have plenty of room over the next 12 to 24 months to buy back shares. And we see that as a potential catalyst moving forward. It was a great quarter. We think, they're the best performing apparel brand in the US right now. They're marketing well through, digital marketing and grassroots kind of marketing campaigns through TikTok and some, Instagram Reels. And then we think the company's got plenty of room to grow. We do think growth will decelerate over the next 12 to 24 months. And I think that's what investors are a little bit nervous about.
Yeah, that's certainly what we heard from the CEO on the call. But also, this is a stock that's up nearly 60% year to date and around 200% over the past year. Is the market just getting over its skis here? Is this a valuation issue that investors should be taking note of?
No, we don't think so. So right now, shares are trading about 14 times this year's earnings. We think estimates for next year are pretty low. Still under $10 a share for next year. We think that's low. We think that'll come up. So we think valuation wise, it's only trading at 14 times, and I think it's deserving of that. We think over the next 12 months, we think shares can get almost to $200.
Zach, just lastly, while we have you here, one of the other major retailers that we're tracking here this morning that could end up being, kind of emblematic of a theme that we're going to see into the back half of this year, Foot Locker, talking about some of the promotional cycles or some of the deep discounting that may need to be done to move through inventory. How much of an outsized impact or even catalyst could that be? Not just in terms of investors who are trying to track up against the margins that companies are putting forward, but also the guide and how this could impact where those margins are moving over the coming quarters.
Yeah, we think Foot Locker is almost the complete opposite of Abercrombie. They're obviously battling, multiple headwinds, long-term headwinds. Its largest distributor, Nike, has seen, kind of a slowdown over the last, 6 to 12 months. And we just think, they're closing a lot of stores. They announced, closures in Europe and Asia. They're going to hand over some of their operations in Eastern Europe. And so, we think there's at least a few more quarters of underperformance here for Foot Locker, at least over the next 6 months. But we think, they're battling really significant long-term headwinds.
Wow. Yeah, we're seeing shares down right now by about 15%. So a lot of other analysts and investors out there perhaps seeing through and sifting through the tea leaves and making a sense of this as well this morning with the same tenor that you have. CFRA analyst Zachary Waring. Zachary, thanks so much for hopping on the program with us.
Thanks for having me.
Certainly. We've got all your markets action ahead. Stay tuned. You're watching Morning Brief. We're taking a closer look at Yahoo Finance's trending tickers here. We've got Berkshire Hathaway, we've got Bath & Body Works, and we've got Sony. 30 seconds on the clock. Let's do all of them. All right, Berkshire Hathaway shares, as of right now, they're fractionally higher by about 0.7%. Guess what? The conglomerate joined the $1 trillion club today. It's in good company, joining 6 other companies, mostly a part of the tech sector, surpassing the milestone here. And even as we're thinking about this, some of the investments that they've made over the past few years and even cozying up to tech a little bit more has really been what's made this possible. You think about the share, the stake that it's taken in Apple, how that adds to the balance sheet, and then also the divestitures of a few key positions as well, Bank of America being one of them recently too.
Well done on the timing, Brad. All right, I'm going to try to do the same here. I'm talking about Bath & Body Works. Shares sliding to the downside. They're down over 6% right now. The soap and fragrance retailer reporting second quarter sales that missed analyst expectations and slashed its full year guidance. CEO saying customers still cautious and seeking value. That's a tune we've heard a lot throughout the day here. This comes after shares were down a little over 5% earlier in the day here. Having said that, the analyst reaction is on that lowered net sales guidance, implying a worsening in sales and that the company's not going to return to growth till 2025. My favorite fun fact here, Gen Z putting pressure on names like this as they switch over to brands like e.l.f. Beauty outside of the traditional, more old school Bath & Body Works brand.
All right, and from fragrances to games, that's a transition. Sony shares right now, they are flat, higher by about 0.8% though. The gaming giant raising the price of its PlayStation 5 in Japan by nearly 20% here. My goodness, PS5 still able to have price increases put into this market? Well, that's what's going to happen here. But ultimately, this comes back to what we're going to be watching closely within this consumer environment within the Asia-Pacific region here. This is like a 4-year-old console that's still able to see price increases. I haven't been able to get my hands on one, so it's probably going to get less likely at this price.
Yeah, we love the nostalgia plays and the current product plays there. So good stuff for Sony. All right, guys, coming up, we've got Nvidia earnings, slowing consumer, key catalysts driving markets today. We'll dive into all those topics next, right here on Catalysts.
A jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Welcome to Catalysts, everyone. I'm Brad Smith alongside Madison Mills. We are 30 minutes into today's trading session. We're watching three catalysts today. Nvidia's high-stakes earnings, retail results painting a mixed picture of the consumer, and, oh yeah, that fallout from CrowdStrike's massive outage.
That's right, but first, it's the day that we've all been waiting for, the biggest stock in the market. Nvidia's second quarter results out after the bell. The company's contributed to about a third of the S&P 500's gains so far this year. How much could the stock potentially move the rest of the market? We'll tell you all about that.
And retail results are giving us a mixed picture of the U.S. consumer. We heard from Foot Locker, Kohl's, and, oh yeah, Abercrombie and Fitch. Rising sales for some of raising sales, and we've got some muted outlooks for others, signaling an uncertain environment for retail ahead here. We'll talk to a strategist who just downgraded consumer discretionary, and we're going to talk about that outlook for the sector in just a few moments.
And CrowdStrike reporting results for the first time since the massive global outage that affected over 8 million Windows devices and impacted a wide variety of sectors, airlines, banking, healthcare, just to name a few. We'll discuss how much of a hit the company could see to its revenue.
All right, but first, investors bracing for a potential big market swing following Nvidia's highly anticipated second quarter earnings results to be released after the bell today. The chip giant is 6% of the S&P 500's market cap and has accounted for about a third of its gains so far this year. We spoke with a big Nvidia bear in the morning brief. David Bahnsen, Chief Investment Officer of the Bahnsen Group. This is what he had to say.
70 times earnings with 100% earnings growth priced in. There's absolutely no margin for error. And on a go-forward basis, there's no doubt that there will end up being some snafus, some revenue hiccup, some margin compression that will throw a lot of water on this party.
From one replay booth to another, Nvidia has outperformed for the last several quarters here, rallying 1,000% from October 2022 lows, and most analysts are still confident that it will continue to do so. The stock has 66 buy ratings on the street here. So with all of this focus going into the report, of course, I was taking a look at some options AI movements and what could potentially take place going into this print that we're going to get later on here. And the expected move, as of right now, we're still looking at a potential move of just under, actually now just over 10% post earnings here. And so that's the type of swing we could see in one direction or another based on options contracts for the ticker symbol NVDA. But it's going to be a larger question of some of the themes that our own Dan Halley has laid out. What does the business look like in terms of the strength in China? What do they talk about there and what they're delivering into that region? And then additionally, what is the overall status for AI demand as seen through or as via the gospel according to NVIDIA right now?
That's 100% right, Brad. And we have to remember that even though David kind of threw cold water on me at this idea, 40% of NVIDIA's revenue comes from a couple of hyperscalers. Sure, maybe that's a risk long term, but we've already heard from those hyperscalers. I'm talking Microsoft, Meta, Amazon, Apple, and they have all across the board said they've increased their AI spend. Yeah. That means more revenue to come for NVIDIA. We are expecting 70% quarter over quarter earnings growth from this company. I don't know how you go into an earnings report with that kind of anticipation and not see a move to the upside if the company is able to deliver. But the question, of course, is the degree to which the street thinks that delivering on those expectations is enough. Is meeting the bar going to be enough, or do they have to far surpass that bar to be able to make the street happy?
It's going to come back to the corporate partners as well. NVIDIA has done a great job of making sure that on the B2B side of the business, that they are seeing not just contracts come their way, which is what they would summarize as demand, but also the partners that are willing to say, okay, in our vision for our own data center, we're committing for not just this amount of chips, but also building out our data center even further. And so we could potentially see, as we've talked with some analysts about in this most recent few weeks as we lead up to NVIDIA's earnings, what could potentially one day be a 1 million chip data center? And you got to imagine what that would be, not just for NVIDIA, but a rising tide for the entire chip space as well here.
Yeah, really great point. And will we see more competition in the space, or will it continue to be NVIDIA as the big shark in the room? But let's turn now to a broader story we are looking at, and that is the cracks showing in the U.S. consumer. Another key driver for markets today, earnings reports from Kohl's and Abercrombie and Fitch, generating mixed reaction from investors. Leaders of both companies pointing to the more challenging and uncertain environment as shoppers pull back on discretionary spending. So what impact can we expect this to have on the broader market? Here to join us, we've got Willem Sells. He's the Global Chief Investment Officer for Private Banking and Wealth Management over at HSBC. Willem, thanks so much for joining us. I want to get to your downgrade of the consumer discretionary sector in just a second, but I want to start on the market action that we are seeing for some of these retailers today. A name like Abercrombie and Fitch was down over 14% the last time I was able to take a look at it. Is that an idiosyncratic story, or is it a story of consumer weakness that could potentially lead to further pressure that could bring down the entire market?
It's about positioning, I think, of companies in the sector, and as well, so what we're seeing in the on the consumer side is, not necessarily that consumption is falling, but that you have more of a bifurcation, what we call a K-shaped, consumer. So at the top end, clearly some, consumers are benefiting from a healthy housing sector, a healthy stock market, whereas at the bottom end, although inflation is falling, prices have not yet fallen, so people feel they're still not better off. So it's clearly a question as to where you're positioned. So if you're a company in the leisure space, in the hotel space, in travel, in entertainment, those kind of things, typically you're in a better environment than if you are in in the lower end, where competition is fierce. You talked earlier on the show about value. There's a fierce, competition, in terms of having the right price point. So, very much a stock pickers market where people need to differentiate.
And so from what you're hearing from some very specific or specialty retailers as of right now, what they're having to do just to move through inventory, some of the deep discounting that they're talking about, some of the promotional pressures that may persist even from this point forward, even on things such as footwear. What does that signal to you as we're moving through a period of the summer months where consumers are known to cyclicality-wise prioritize more of that services spending versus goods, and then on top of that, we're about to go into a very highly promotional period. What does that pass-through and that read-through look like then for some of these specialty retailers?
Yeah, so as you were saying, from a consumer perspective, people feel very differently when you're, looking at, consumer surveys. Different surveys tell you different things. Different types of consumers feel very different about their, their purchasing power, the state of the economy, and so on. And as you were saying as well, and that's why I mentioned leisure, hotel, business, and so on, travel and entertainment, because people are shifting the share of consumption more and more towards towards experiences rather than accumulating goods. So it's all about finding those companies that are that have the pricing power and that are positioned in the right space, to tailor to this, more to the entertainment space, more to the services space, and more to the higher end.
We often see the mindset of the consumer really hinge upon what the prospects for employment look like. If we see an unemployment at the next reading come out on a 5 handle at some juncture, what does that do for the consumer psyche?
Ultimately, it should start to have an effect, that's for sure, when it rises, significantly. People have been talking about a 0.5% rise triggering that. I think it also depends as to, relative to previous cycles, that you come from a very low base. So if it comes from a very, very low base to, a low base, then maybe, it has less of an effect than if you go if you start from a moderate level of unemployment and rise from there, because it's a question as to how afraid am I to lose my job. And there it's important to realize that although we have fewer companies that are hiring, there are still, there's still quite a low number, historically speaking, of companies that are firing. So, that lowers somewhat or limits somewhat the concern of consumers about losing their jobs. At the same time, as we said, wage growth is still relatively decent. Inflation is falling, so the real spending power is rising. But indeed, people are much more differentiating and choosing where they put their money to work.
So how much of this weakness that we're seeing is real versus kind of a feedback loop where people like me admittedly come on and talk about the risks of a recession because I'm getting banknotes all day that tell me that people are still worried about it, and then that leads to executives being worried about increasing hiring. They may be focused on attrition instead of layoffs. But is that feedback loop what's making us start to see some cracks in this labor market? Or is there a real sickness there that maybe we're not paying enough attention to?
In other words, the fear of fear itself is what you were talking about. That is ultimately a risk. I don't think it is very high because if you look at corporate confidence in itself, corporates, not just in the consumer space, but in other sectors as well. If you add it all up, corporates are making records amounts of profits. Margins are near record highs. Profitability is being boosted, obviously, to some extent by that improvement in innovation and productivity that we're seeing. Interest rates are going to start to fall, and cost pressures, especially on goods, are easing as well. So companies are in a healthy state. Again, more bifurcation between the big and the strong ones versus the weaker ones. But corporates are generally in good health. If that is the case, I don't see a very sharp deterioration of the labor market or a sharp pickup in firing, but indeed there is an easing of the labor market pressures. That, by the way, helps the Fed. But it leads to a picture, I think, where the U.S. economy is slowing but not stalling, and recession risks are low.
Well, let's get to that downgrade to the consumer discretionary sector that you did to neutral. You said the sector needs a selective approach as some companies in some sections struggling more than others. Walk our investors listening to this through that. What is the mindset for that stock picking narrative and thesis that they should be applying to their own stock picking?
So it comes back to that K-shaped, consumer where you have, some consumers feeling healthy, being secure in their jobs, and therefore choosing to spend, more than others, but also choosing to spend more on those services, more on that leisure, on those hotels and so on. Those are the types of companies that you want in terms of positioning within the sector. And then, and then within those buckets, we need to distinguish between the weaker and the stronger ones. Because of course, if you have a weakening economy, you want companies that have the pricing power, because of their positioning, they're in the markets and their pricing power. So those are the types of companies that you want to look at. When you have a bifurcated market, it's natural to be neutral rather than overweight or underweight. There are opportunities, but there are also companies to avoid.
Willem Sells, Global Chief Investment Officer for Private Banking and Wealth Management at HSBC. Willem, great to see you. Great to have you back on Yahoo Finance. Appreciate it.
Real pleasure. Thanks for having me.
Thank you. Coming up, everyone, which stocks are well positioned to weather market uncertainty? We'll talk to the CEO of Defiance ETFs about her top picks next. There is a lot of uncertainty ahead for markets, with rate cuts on the horizon, debate about the health of the consumer, and the U.S. election in November. Oh, yeah. So, which stocks are best positioned to weather any and every storm? Our next guest has a few names in mind, including Broadcom, MicroStrategy, Supermicrocomputer, and Eli Lilly. We've got Sylvia Jablonski here in studio. She is the CEO and Chief Investment Officer of Defiance ETF. Sylvia, great to have you here in studio with us.
Good morning. Thanks for having me.
Absolutely. Okay, so let's start, if we may, with Broadcom. That's one of the bigger moves that we're tracking here on the morning. We actually spoke to another bull on the stock last hour, David Bahnsen, Chief Investment Officer of the Bahnsen Group. I want to see what he had to say, want to play for you what he had to say, and then we'll get your reaction on the other side.
Sounds good.
Broadcom to me is not about the AI chip story. It happens to be up about 500% since we bought it, largely because of AI, but it's a free cash flow growth story.
All right, so take us here into your thesis on Broadcom, and I mean, comparing that to what you heard from David.
Yeah, I agree with David. I think it's a great revenue growth story. It's one of the top leaders in the chip names. You know, everybody's focused on Nvidia, but you know, what else in chips is moving? It's Broadcom. And I think what's interesting about this stock is that it's part of the teleconnectivity trade, right? So it's part of that 6G, the lower latency, the network services, wireless communications. That's what their chips feed. And if you think about AI and what we need in order for AI to work and for supercomputing to work, it's processing data very, very quickly. And in order to do that, you do need the Broadcom chips and you need that 6G connectivity. So I think that there's a big win for that stock in the future.
Is that an anticipation that Broadcom is going to take more share from Nvidia, or is it specific to the Broadcom story?
I think it's specific to the Broadcom story, which is great. In a way, they don't compete with Nvidia. They kind of go at it in a different way because they are focused on that data, that data center, which they compete a little bit there, but they have the wireless focus. So I think it's the cousin of Nvidia. If Nvidia goes up, Broadcom will also go up, and we've levered it up too. We've put a 2x leverage point on it too. So having that tradable product out there with leverage also increases the amount of shares that people buy on a daily basis.
It's really interesting because I'm trying to figure out for Broadcom where they sit in this AI stack here, because you have the applications on top of the models, on top of the chips. I mean, where specifically, for investors that are trying to wrap their name around where they'll see a delta in Broadcom's business as a result of demand that the company is talking about, where they should fit them within that stack?
Yeah, I think that they should fit them specifically in the tech connectivity bucket. So if you think about things like smart cars, robotics, 6G, 5G, the evolution of smart cities, the evolution of the way that we communicate, ChatGPT, all the data that we consume, it has to come at high speed and be processed and things like this. And I think that Broadcom plays well there.
I want to talk to you about MicroStrategy. I know this is one of your plays, and we have had the fascinating opportunity to speak with Michael Saylor several times on our program. So I want us to take a quick listen to our soundbite from Michael Saylor. He is the Chief Executive Chairman over at MicroStrategy. Take a listen.
We're buying all the time. We're buying every quarter. We're buying the lows, the mids, the highs. I'll be buying the top forever, because I'm expecting Bitcoin will continue to appreciate as digital capital.
So he's basically saying there we're buying even at the highs, right?
Yeah.
We're not just buying the dip. And of course, that was in a week where Bitcoin was moving to the downside. But I'm fascinated in his maximalist bullishness on crypto and Bitcoin, and he doesn't seem to ever want to sell it to make a profit. How does that play into your thinking on the longevity of MicroStrategy?
Well, a couple of things. I think, the company is profitable on their software and business intelligence sales. But as he said, he is the best dollar cost averager of Bitcoin that ever walked this earth. And he continues to do it at lows, mediums, and highs, right? And that's kind of what we preach for investing, right? You can't time the market. He just knows that he has to use his cash and buy it up because long term, he's very bullish on this. And it's paying off. If you look at what happened to Bitcoin in like January, February, March, when it was up about 60%, this stock was up 3 times that. It's still tracking 2 to 3x Bitcoin, 2 to 3x time, multiplied by the performance of the Bitcoin ETFs out there. This is another one that we actually levered up, and the demand has been probably the fastest that we've ever seen in an ETF before. People love Bitcoin. They love the volatility. They love the leverage versions of it, and MicroStrategy is proving to be an awesome proxy for that.
I mean, for cryptocurrency, it's so interesting to track how it trades around specific events,
Yes.
whether it be events like ETF approvals or halving. And so, what is the next major event that we could see a dollar cost averaging type of momentum or trade initiated from a whale like MicroStrategy as a result of knowing what we've seen in the past off of those events and the volatility in some cases, but also the spikes as well?
Well, I think, if you look at what happened over the last couple of days, if he's, picked it up this morning and it goes back to where it was a few days ago, right there, he's got a, $4,000 worth of gains on his crypto. But the election could be interesting. Suddenly everyone in politics is very bullish on crypto. And if you get a president who's kind of like at the crypto conference and the face of crypto for, maybe that's the next, momentum that kind of pushes it up. Into that 70K range again. Who knows?
Yeah. I want to end with you on Supermicro Computer.
Yes.
Fascinating 24 hours for this name. Obviously, the Hindenburg research report comes out now this morning. We know Supermicro is delaying its 10K filing. The shares for SMCI down over 40% in a month, and I believe today they're down a little over 25% right now. Does that change your view on SMCI?
It doesn't. What it does is, so I'm going to kind of like sit back and watch how this plays out, right? But if this plays out, meaning that the accounting is okay, or there's kind of a procedure in place to ensure we're on the right path with the reporting and things like Hindenburg is concerned about, then this is a great buy on the dip opportunity. This stock has been up 779% in the last 2 years. They're a leader in cooling data centers, so they have the most energy efficient way essentially to provide the huge cloud providers like Amazon, Google, Microsoft with cooling tech basically for AI. So absolute necessity in this space. They have to clean up shop, and I think buy on the dip, you're going to have that 10-for-1 split in October. It's a great opportunity, but just let's sit on the news for a couple of days and see what happens.
Are you
the dip buyers are coming in already, though.
Yeah. Are you one of them?
I'm going to be one of them.
No?
Yeah.
Okay.
Yeah.
By how much?
By how much?
Yeah.
How much to buy, or?
Yeah, like how bullish are you feeling?
Yeah, I mean, well, I'm not bullish in the short term. I think that, when you're down 25%, there's a little bit of a problem, right? But I really like getting things on sale. And I think that this stock, again, looking into the future, AI is going to go on forever. There's going to be different iterations of AI, and this is a top player. So a little bit of noise now will, hopefully get you to the pot of gold in the future.
Great stuff, Sylvia. Thanks so much for joining us and
Thank
reacting
you.
to that news on SMCI with us. We do really appreciate it. Sylvia Jablonski, Defiance ETF CEO and Chief Investment Officer. Let's get over to some trending tickers that we've got for you this morning, starting with Bank of America. Warren Buffett's selling spree of Bank of America continues with an unloading of an additional 24.7 million shares, totaling $982 million. The sale disclosed in a filing late Tuesday with the SEC. Now, what's interesting is that Berkshire still does have a substantial stake in Bank of America with nearly over 900 million shares. So not a small amount of holdings, but still selling off that $982 million of Bank of America shares here is obviously going to be a potentially bearish signal for Bank of America. And this comes as Berkshire, by the way, has consistently been selling off some of its Bank of America shares over the last quarter here, and we've seen Berkshire really increasing some of its defensive plays, getting out even Apple stock over the past quarter here, sort of taking a risk-off approach to a quarter that has seen a lot of volatility. We saw the market rout happening in early August. We've had continued geopolitical tensions. We've got that election coming up in November, and you've seen Berkshire and Warren Buffett, of course, taking a little bit of a defensive approach to a year with a lot of big question marks, Brad.
Yeah, trimming from Berkshire Hathaway and its position in Bank of America. I mean, and this is a big deal, especially considering for Bank of America. I mean, it's a company that we're looking at that has about 64% institutional ownership. So anytime one of the largest holders of the outstanding shares is deciding, okay, maybe we want to sit on a little bit more cash right now. Maybe we want to have a little bit more dry powder to be able to deploy elsewhere, especially if you do see some significant dips and very ripe opportunities for larger, garpier and growth areas in the market starts to make themselves known, then you want to be able to activate that quickly. And so I think that's what we're starting to see a little bit more of, especially in some of the larger or more outsized stakes that have seen their run up in financials and now trying to figure out where do we take profits and deploy that elsewhere once these dip buying opportunities start to emerge in critical mass.
Absolutely. It's such a great point, Brad, and also points to kind of the so what factor for Berkshire and Bank of America in particular. This is Warren Buffett. This is the king of investment strategies. If he is taking a risk off approach to investments, what does that tell us about where the market might be heading? What does he know that the rest of the investment community may not be sussing out? So that is why we love to look at Berkshire's holdings. Clearly working for them as they hit that $1 trillion market cap earlier today. Now coming up, crop shortages have led to rising prices in cocoa. We'll explain the impact that's having on some stocks in the consumer discretionary space when we come back. Cocoa prices still on a tear this year. The costs primarily related to weather and crop disease in West Africa, which has led to major supply shortages. And this is weighing on some consumer-facing companies here like Hershey's, as higher chocolate costs will weigh on company profits. And you can see there, cocoa futures up over 80% year to date. So for more on the long-term and short-term future for cocoa prices, we're going to welcome in Olen Hansen. He is Saxo Bank's head of commodity strategy. It's great to have you here. So talk to me about the degree to which you anticipate cocoa prices continuing this run to the upside, because we have seen a little bit of volatility over the last couple of months, particularly since May. We've seen a couple of bottoms in cocoa prices. Do you anticipate any relief in the price anytime soon?
Well, good morning and greetings from Copenhagen. I think what we've seen right now is basically the market consolidating, but obviously at a much higher level than we have seen in previous years. And it just highlights that even though when you say when you look at commodities and you say the best cure for a high price is a high price because it incentivizes production and it lowers demand. So far, we haven't really seen those structures really unfold because the producers in question here is primarily West Africa, and it does take time for the economics, the farm gate prices to raise to levels where they can increase production. At the same time, it looks like global demand remains fairly robust. I suppose we will still buy our chocolate bar, even though we have to pay a few cents more for it.
Yeah, I mean, we need those little luxuries, Ole, so we got to get the chocolate. But all these things considered, and you're pointing out a key part of this industry, which is the end-use industries that are reliable and tracking cocoa prices here. So what does that mean in terms of pass through for higher prices, and for how extended are you kind of calculating or running the math on your side that we could see higher prices for longer because of the cocoa price input?
Well, we just have to look at the forward prices in the futures market, and while we are currently settling in around just below $8,000 a ton in the front month's contract, which is December, that's basically above the long-term average, which was around 2,500. Then the next year, if we look into the next season crop, which is basically between October and March, the harvest, once we're through that, even though we have that harvest, the prices for May next year are still around something like $6,000. So it does indicate that we're looking potentially into 2026 before potentially we can get some of this under control. And that really is a combination of two things. First and foremost, that the farmers are receiving more for their product. They can spend more money on fertilizers and also pesticides, which is a key right now due to some diseases they have in some of the crops. But also that we see the weather continue to improve. And obviously the weather is a big if here, because we have seen a very troubled season on the southern hemisphere when it comes to food production. We've seen cocoa, obviously, as we talk about now, but coffee prices hitting record highs as well. So it is the weather that ultimately will determine whether we can get some more balance in the market. And that is really not for us to guess where that's going.
You know, it's so interesting. I was just about to bring that up too, because I mean, we're coming off of a year where in the US alone, we saw during 2023 a record number of billion-dollar weather events. And that directly passes through, especially as you start to think about other parts of the world that are producing crops and producing cocoa and trying to make sure that regardless of whether there is able to be steady production, how is production going to need to shift? How is the farming and the cultivation of cocoa going to need to change in order to not be so impacted by events and severe weather events that foreseeable future are continuing to worsen at this juncture?
Well, it is ultimately a question about location. And when we look at where the bulk of the world's cocoa beans are being produced, that is West Africa. It is close to the equator. It's where the temperature and the climate in recent years has been the best, most supportive for this kind of production. So you can't just move it to somewhere else. We're seeing a bit of a pickup in Central America, but not to the extent that it can replace what we're seeing in Africa. So right now it is mostly a question of having the means to support the farmers through among other things fertilizers, and then again just trying to be smart with how water is being consumed. But many of these farmers, their lots are probably the size of a couple of football fields, so they don't really have much in terms of selling power when they want to sell their product. So that's another issue. They really are dependent on what kind of price that the government is setting for them.
All right, Ole Hansen, Saxo Bank's head of commodity strategy. Thanks so much for joining us on all things cocoa prices. We appreciate it.
Thank you.
We're going to turn now to our chart of the day. It is finally here, guys. All eyes on Nvidia as they report their latest earnings expected this afternoon. But that extra attention, it didn't just start today. Since its pullback last month, retail investors have been buying the dip in Nvidia. Wall Street Journal pointing out that $7.4 billion worth of retail trades tied to Nvidia were made on August 1st. That was the third highest daily tally on the Nasdaq since 2016. I just want to talk to this chart behind me here showing that retail trade tied to Nvidia in billions. And you can see here, not a lot of activity. Around here, you're getting to that October 2022 low for Nvidia. It has rallied up over 1,000% since that October 2022 low. And you can see the amount of money soaring in from retail investors, again, buying that dip that we saw in October with that market rout. Now, one key question is going to be smart money versus retail investor money, as it's traditionally referred to. We know from Bank of America research, from earlier guests we had on our show over with Russell Investments, that hedge funds are pouring out of the Magnificent Seven at record rates for the year. And specifically when compared to the rates that we saw back in February, this is the biggest sell-off we've seen from hedge funds in the tech sector. So is that something that retail investors should be concerned about when they are the ones pouring into some of these big tech names. Obviously, Nvidia is the key focus for the day, when some of those hedge funds have already been doing some profit taking some off the top for some of these big tech names. Of course, that's going to be answered when we get those Nvidia earnings this evening. We are expecting from the options market side of things a potential 10% move in either direction off of those results. We're going to have all of your markets action ahead, so stay tuned right here for more. You're watching Catalysts.
Let's turn now to another significant earnings report out after the bell today. CrowdStrike. This is going to be the company's first report since that massive software update triggered global outages back in July. Now, Delta has said that the issue will cost the airline about $500 million. CrowdStrike shares are still off about 20% since the outage, but are up by about 5% year to date, holding on to those gains. So, what kind of fallout can we expect for CrowdStrike, and what do they have to say? We've got Fatima Boulani, who is the co-head of U.S. Software Equity Research over at Citi. Fatima, thank you so much for taking some time here with us. You've got a buy rating, $300 price target on the stock. What do you want to hear from the company after a massive outage like the one that wreaked havoc across so many different industries?
Thanks for having me. I'm happy to be here. Look, I think this management team tonight has the unenviable task of assuaging a lot of nerves about the extent of new business impact, expansionary impact within their install base in the near term, but then also helping rebuild investor confidence that this truly was a black swan error, and it is not going to impair the medium-term prospects and trajectory of the business. So a lot of threading of the needle here is what we're going to be expecting from this management team today. And in the same breath, we are also expecting maybe more medium, longer term updates at the company's upcoming investor briefing at their conference slated for about 3 weeks from now.
Fatima, how concerned are you about the guidance piece when it comes to CrowdStrike and the kind of conservative approach that they are likely to take to cutting that full year guidance? Is that potentially going to put an undue amount of pressure on the stock after the earnings print?
I think that's a very important question and a very fair question. The stock has had a very nice bounce off the bottom. So, in a lot of ways, in our conversations with institutional investors, there is absolutely an appetite for this company to frankly just throw the book at guidance, just, every possible parameter or permutation that they can throw into guidance and frankly de-risk the numbers is exactly what investors are looking for. But again, I'll come back to the fact that, hey, this is a battle. They need to win the war again on reinvigorating that confidence. And that is going to tie back to, they have a big, hairy, audacious goal around $10 billion of ARR. And longer term investors with duration are going to want to make sure that that's absolutely intact and there isn't going to be much deviation. But back to your point about numbers risk today, I think what they say about numbers risk is going to be equally as important as how much they de-risk or how much they potentially guide below consensus, which is fairly appreciated and accepted, we think, by most institutional investors.
Given the amount of AI demand that has been circulating for several earnings quarters at this juncture and just continued to be amped up in earnings calls as well, it seems like CrowdStrike should be in an ideal position to capitalize, even as this issue that we've been talking about with the outage has impacted perhaps the sentiment going into this report. How do they need to be able to tell investors or showcase to analysts as well that they can be able to capitalize on where that market demand is going, knowing that there's going to be a layering on of demand for cybersecurity components on top of the growing data centers, the demand for chips, and all of the different endpoints that are required for generative AI to really hit critical mass?
Look, I think we're very much focused on the blocking and tackling elements of this. The generative AI angle to this story and the investment case here is actually very attractive. Cybersecurity it's no surprise that within cybersecurity, there's actually a dearth of talent. You can't hire, qualified information security folks fast enough because there aren't enough qualified individuals. I think some market estimates have about a 3 to 4 million person headcount deficit, right? So that is a tremendous place of value that generative AI can deliver very strong value proposition. And CrowdStrike is absolutely in the crosshairs of that in a very positive way. But, I think very much right now within the context of this report, it's our sense is it's going to have to more focus around what are they doing to keep customers happy, maintaining gross churn, doing right by customers with discounts and, having the correct and appropriate customer satisfaction posture. So the generative AI stuff is good, but we really have to focus on the meat and potatoes.
Fatima, final 30 seconds here. I know that you increased your price target on Sentinel-1 to $25 from $20, but you maintained your neutral rating. To what extent is there going to be a read-through from the positive results for Sentinel-1, even though the stock is down right now, to CrowdStrike earnings?
I think this is definitely, to us, reads like a David versus Goliath battle. Everything we heard from Sentinel-1 yesterday was very much around, building up the kind of anticipation and optimism around, hey, this is an opportunity as an underdog of smaller scale in this market for us to rise to the occasion. But we respect the fact that the CEO, while kind of laying the cards on the table, didn't necessarily overextend his hand on, hey, we can grab customers yesterday and dissatisfied customers yesterday. So I think they've got the right pieces in place. For Sentinel, we think it's mostly going to be a show me story here, as opposed to kind of positive vibes around market share, outsized market share capture. So we're more on the sidelines to see more evidence that they are taking more than their fair share of these disaffected customers that they are gearing up to grab.
Fatima, always great to have your insights. Thanks so much for hopping on with us this morning. That was Fatima Boolani, co-head of U.S. Software Equity Research over at Citi. We're going to get another peek into the health of the consumer with Lego earnings that dropped overnight. Our very own Brian Sozzi got a chance to speak to the CEO about those results.
Lego continues to defy the odds in the toy industry. Let's bring in Lego CEO Niels B. Christensen. Niels, I can't believe it's been 6 months since we last talked. Good to see you as always here. So really, one number among many that sticks out in this first half results is your sales. Simply sales, up 13% year over year against the backdrop of a struggling toy industry. Help our community here at Yahoo Finance understand how you're able to outperform some of those broader trends.
No, it's clearly taking market share in a toy market that's not growing right now, as you say, and it's about our brand standing really strong right now. We have a portfolio of products that cuts different age groups and different interests that really is performing very well. We've been increasing our store network. We've been investing behind Lego.com, and so I think it's all coming together and really helping us to take the share that leads to growth right now.
How will Lego, or how are you preparing the company for the age of AI, where kids may get even more engrossed in video games amongst many other digital activities they can do?
Now I tell you, we're preparing for that. So we're beefing up our own digital competence quite significantly and have been doing so over the last 3-4 years, because you're right. You can imagine all kinds of things where you can get different, AI or different help to be creative. It can just lift the creator level of kids probably sometimes in the future. And if anything, building with Lego bricks actually lends itself entirely to this creativity and this building thing. So I think there are good potentials there, and we make sure that we are front running that.
Now I'm just realizing in real time, my parents never helped me put my Lego sets together. They just watched me struggle on the floor. But that's a discussion for a different day. I got to mention that to my parents. What's your sense on how the holidays are going to come up fast? When you talk to these big retailers, how are they planning the toy category for some of that peak buying season?
No, I think by and large, it's hard to say. It's even 4 months out. That's a long time in our industry. But I think at least when I look at it with from our lens here, there's good momentum, and it doesn't seem like things are very different when I look forward than if I look 4 months backwards. So in that sense, I would expect a bit more of the same and kind of the normal seasonality, if you want, throughout the year, with also, I think, for the Lego brand, a very decent Christmas season as well.
Take us inside some of the numbers in your business, Niels. We've started to see inflation come down across the world, which is, of course, a very good thing. How are you seeing that as well in the materials that are used to make Lego bricks, and are you passing on some of those savings to shoppers?
Yeah, no, I think we saw most of that last year, so we're seeing that continuing into this year, and therefore also we were never loading any of those material cost increases into products. So there's not been a big thing. We kind of kept our level through that, and we're doing that now. But we are also, if you think about the business and our materials, we're investing heavily into sustainable materials. So in this half year, we're actually buying 30% of all the resin or the raw material for Lego bricks have been what is called certified mass balance material. So material that has a very high element of non-fossil based materials in it. So either renewable or sustainable bio-based materials. So 30% of everything we have bought for raw material. That translates into 22% of a Lego brick on average being non-fossil or not being dependent on oil being pumped up from the ground. So we've been able to grow 13%, as you say, and we have spent less oil-based plastic for the same period. And that's a milestone for us to be able to grow while spending less fossil-based materials. That's a major thing. We've been investing heavily into that. Those materials are more expensive, obviously, than normal materials. And we've been able to do that and decided not to unload that cost either to consumers, to really make sure we are standing in there and trying to push the industry in the right direction on materials. So I think that's probably one of the biggest shout outs for this half year, apart from the financials. Then that's a big milestone.
Do you think in our lifetime we will get that fully sustainable or renewable Lego brick?
Yes.
How do you get there?
I think we've actually spent, if you go 5 years back, we spent some years really investigating. I think we were deep into 600 different materials to really figure out what would be the way forward to take the brick that you and I played with when we were kids and make sure that it's compatible with the one you buy tomorrow. And that's the case. That's not so easy with some of these new materials. So by really doing the groundwork, we've been able now to focus in on what we think is the path to a solution. And now we are investing heavily behind that. So getting to 30% this year, we're committed to increase that percentage again in the second half and into next year. I think there is a line of sight to us being 100% sustainable on materials by 2032, which is our ambition. So it won't be inexpensive, but we're committed to take that journey.
That's good to hear. And lastly, before I let you go, you and I in the past have talked about your expansion plans in China. You've opened up retail stores there. I didn't see it mentioned in the earnings release. What are you seeing in terms of growth in China? Of course, that economy has slowed down. And then what do your expansion plans in China look like over the next 6 months?
Right. I mean, it's clear we are growing rapidly in the US and in Europe. We are more flattish in China. I think that's even taking market share probably in China, where the economic environment is more strained. We believe in the long-term potential in the Chinese market. There are a lot of kids in China that would benefit from Lego Play. So over there, we continue to open stores at a slightly lower pace than what we've done in recent years, but we open stores, we build the brand and invest into the longer-term potential, while right now we see more momentum in the US and most of Europe.
All right, we'll leave it there. Always great to get some time with you. Lego CEO Niels B. Christensen, good luck this holiday season. We'll be in touch.
Thank you very much. We will. Thanks.
All right, much more ahead on Yahoo Finance on the other side of the break.
Apple is laying off 100 jobs across its digital service group. That is according to reporting originally from Bloomberg. Now, the cuts will reportedly come from the team that runs the Apple Book and Apple News areas of the company. And this would be the fourth round of layoffs at Apple this year. Now, obviously, it's important to note that these layoffs are coming from very specific parts of the company. Again, Apple Book and Apple News are the two. So it's not also that big of a layoff. Obviously, it's 100 jobs job cuts. But it is interesting given the shift we have seen from Apple into the services side of the business that has been the primary driver of their earnings growth. Quarter after quarter, we have seen this story. So is this a sign of things to come from the company? And of course, Brad, as you know, this comes after news that Luca Maestri is leaving his post as the CFO. He was able to maintain a lack of layoffs, focusing rather potentially on attrition at the company to maintain lower costs for labor at Apple. Is this the beginning of a potential shift where more layoffs could come from Apple, or is this just more of the same, a focus on the services side of the business?
Yeah, one of the huge things. I mean, it just showcases some of the priorities for Apple as of right now, even with this shift. It is important to note as well that this comes after, as you were mentioning, the cuts that we had seen earlier in the year of a little more than 600 jobs, and that was the biggest round of layoffs since the pandemic. We had heard from tech companies about where they overhired and where they now needed to re-strategize or reprioritize given some of where the market demand is actually moving and reallocating some of those internal resources here. So it's not just cuts, it perhaps also entails for some of those positions being reallocated elsewhere within the business. And we'll see how that actually gives us a little bit more inclination or a line of sight into how Apple is really prioritizing what its output needs to look like at this near point in time. But ultimately here, yes, major kind of C-suite shakeup, but not even a shakeup. You've got a person that's been there for years in Kevin, who's going to be taking over as the CFO now. So more of kind of the keeping of the guards, just one of them kind of rolling off and saying, hey, I'm passing the baton.
Passing the baton, but still staying in the room a little bit,
Still
staying involved.
Yeah, I'll be in that chair over there, just like in the back.
He'll just be monitoring from afar, but also close. I love when they do that. I'm sure the people taking those jobs over love that feeling too. All right, well, coming up, we've got Wealth dedicated to all of your personal finance needs. Brad's going to stick around with you right here for the next hour, so stay tuned for more.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. Hey, on today's show, are you convinced or think that you missed the boat on Nvidia? Well, we'll talk about how you can still get into the AI trade via ETFs. And I hate to say it, but there's only one-ish month left of summer. Maybe you took a vacation, bought some new clothes, went to a lot of restaurants perhaps for all the foodies out there. Well, we're gonna get some tips on how you can recover from a spending hangover if you've got one. Plus, we're looking ahead to the Labor Day weekend, and if you feel like continuing to spend, on the other side of that, we've got the perfect guest to run you through some of the best deals that you can take advantage of. All that and much more during today's show. But right now, stocks are mixed today as investors look ahead to Nvidia earnings that's coming out after the close of trade. Traders in the options market right now, they're expecting the report to spark a $300 billion swing in the shares in either direction. So to discuss how you can cash into the chip trade or at least evaluate whether or not you should be playing in it ahead of the crucial report, we've got Ben Slavin, who is the BNY Mellon Global Head of ETFs as part of the ETF report brought to you by Invesco QQQ. Ben, great to have you here in studio with us. Okay, so we were taking a look at what this options market and what these options contracts are really pertaining. It could be anywhere between a 10 to 11% swing in the stock price that we see upwards or downwards here. What do you make of some of the options contracts that we're seeing and where ETFs right now are starting to be picked up a little bit more in advance of this Nvidia earnings report?
Look, all eyes are on Nvidia, of course, and really, given the data that we have coming out next week, I think today it's really going to set the tone for the market here, really in the week until we get that payroll data next week. And we see action on ETFs. Certainly, we see investors positioning themselves. And I think one thing that's very important for investors really to understand is what those weights are in the ETFs they hold. Obviously, Nvidia, given the big run-up in the stock, is a significant weight in not just the S&P, but a wide variety, several hundred ETFs that hold the stock. And so obviously, depending on which way things go here, you're going to see a big impact and those ETFs are going to move.
I had to sprint over to the desk for this conversation because, I mean, there's so much that we've been tracking going into this report. What are the most actively traded ETFs that you're seeing around the AI thesis right now or around the Nvidia adjacency right now?
I mean, those ETFs have been attracting flow this year, not surprising. Yeah. And I think ETFs are offering a wide variety of thematic plays on AI and, of course, tech. I think, again, what is happening, investors really starting to look through and sort through the nuances between all the new products that are coming out to market. And there's a wide range out there, again, from broad-based sector ETFs that, again, invest in the theme, all the way down to single stock ETFs. We even saw an Nvidia single stock ETF take in more than $3 billion this year.
Which one was that?
As a leverage play, just simply looking at Nvidia stock that, again, has been popular with investors as well. And then, again, running the gamut between more thematic plays where it's a smaller weight and unlevered, of course.
What are some of the perhaps secondary or even tertiary themes that we're seeing try to not take advantage of the fanfare around AI right now, but I guess just be some of the beneficiaries on the side around this trade and other themes that are starting to prevail as well?
Yeah, one thing that we also are seeing a big trend in the ETF market is really this rise of active. So especially at this point in the market cycle, and certainly around tech, but also just more broadly across the market, you've seen a flood of actively managed ETFs come to market, and the flows have started to pick up. So this year, year to date, over 25% of the inflows, the fresh cash coming into ETFs, have been in actively managed product, which is about 3 to 3.5 times the percentage of passive product, which again is where ETFs are kind of more known for, but it's starting to change. And again, investors are voting with their cash.
I mean, from what you've seen in the flows right now, does it seem like Nvidia is, or at least the valuation that's surrounding Nvidia, is it ahead of its skis at this juncture? And how does that get priced into some of the ETFs that either have it as a component or are simply trading on Nvidia as the sole thesis?
It's a great question, and the one that's hotly debated. I think when we talk to our clients, we talk to advisors, I think one of the big risks that I think many are thinking about really is around the concentration. Certainly we saw this, and continue to see this with the quote unquote Mag 7, certainly the run up in Nvidia. And I think, again, a lot of investors are trying to understand what their real exposure is in some of these ETFs where, again, they've had these big run-ups in price and try to look at ways to diversify or at least mitigate their concentration risk in some of these stocks, given some of the high valuation that we've seen. And you've started to see some rotation into other assets as well. And again, another thing we've seen on the fixed income side, again, given where rate expectations are too.
All right, some really fascinating insights. Ben Slavin, who is the BNY Mellon Global Head of ETFs. Thanks so much for taking the time here with us.
Great, thanks for being here.
Absolutely. Well, the number of 401k millionaires is on the rise. Those are people who've saved $1 million plus in their retirement accounts. As of the second quarter of 2024, nearly 500,000 Fidelity 401k accounts had balances of $1 million or more, and that's up over 2% compared to last quarter, according to Fidelity Investments. Now, the average balance for a 401k millionaire is nearly $1.6 million. And the number of IRA millionaires also hitting a record high, according to the analysis. Nearly 400,000 people carry a balance of $1 million or more in their IRAs. That's a 6% jump from the first quarter. But for everyone else, the non-millionaires, I guess some might call them, and that would be factual, the average 401k account balance is a little over $127,000, and the average IRA balance is just over $129,000. And Gen X, let's get generational with it, if you will. The Gen X, those between the ages of 44 and 59, they're kicking up for their retirement savings as well here. Total IRA contributions from that generation up 30% compared to a year ago. This is all according to Fidelity's latest findings. We'll continue to track any developments on that. But in the meantime here, it's time to put the credit card down. Coming up, we'll tell you how to get your finances back on track after a summer of tapping, swiping, spending. All that and much more coming up. As the summer season slowly comes to an end, oh my gosh, wipe the tears from your eyes. It is a good idea to check in on those finances. You might be feeling the repercussions of your spending in the last few months. You're not alone. Let's call it a summer financial hangover. Financial overindulgence can leave us feeling stressed and even overwhelmed when bills are due. For tips on how to recover from this hangover, we've got Jessica Perrone, her Financial IQ founder, back in studio with us. Thanks so much for taking the time here with us, Jessica. I mean, look, yeah, spending hangover, but it was fun. It was fun, I guess, while we executed the spending, but now it's the accountability and the accounting afterwards.
Right.
So where do people need to begin? You had 6 tips for this. Let's boil it down to 3, though.
Sure, absolutely. And you're absolutely right. But I'd almost use the word epic, right? Sometimes we had an epic time. I don't know, do people even use that word anymore? Or am I like really?
For today, we'll use it.
Okay, we'll use it for today. Well, the first thing that you can do is really look at your spending. Where did that money go? You're seeing the credit card statement, right?
Yeah.
And you're like, where did it go? So really looking into your credit card statements, your bank statements, and kind of gauge where that money went. And then the next thing you want to do once you've sort of looked at where it went is start thinking to the future. So we want to start a spending journal if we're the type of person that likes to put down to a pen and a paper and actually learn that way. Or there's some great apps out there as well. Mint just became Credit Karma, and that is a great online tracking app.
Okay, and then also paying down debt here.
Oh, yes.
I mean,
yes.
when we're talking about paying down debt, it's never fun to really kind of brainstorm and think about that, but highly beneficial.
Absolutely.
As you're able to carve away with it. What's the planning that you would advise people go forward with there?
So the first thing to think about with debt is good debt versus bad debt. And bad debt is typically your high interest credit card debt. And the best way to really look at this, I mean, there's a couple ways to do it, but one of the number one ways that I like to recommend to my clients is to really sort your credit cards by interest rates and tackle those ones with the highest interest rate first.
Okay, so as we're thinking about how people can be budgeting, for investors out there as well that are trying to figure out, okay, where is it wise for me to be looking at the market, sensing opportunities versus budgeting and still sitting on some cash, how should they be setting goals? What's the checklist that they should be working through there?
Absolutely. So you're so right. You can budget for savings, you can budget for credit card debt, and you can also budget for investing. And that's all part of your budgeting worksheet, really where you're going to be putting your money. And that's what a budget is. It is telling your money where to go as opposed to wondering where it went.
Absolutely. And then just lastly, I was taking a look at your website, and you have a blog up on this right now talking about the holiday. And I mean, my goodness, we're at the end of August, and we're also already needing to think about budgeting for the holidays. And we were speaking actually with AAA about this and what the anticipations are going into that. You know, as you're just getting your broader sense of where prices could move, how people need to be budgeting for the holidays, what's your advice, your guidance there?
Absolutely. And people think I'm crazy when I talk about budgeting for the holidays right now. But really, this is the time to start creating your budget. And the best way to do it is one of 2 ways. The first one is kind of look at your spending from last year. You know, what did you spend on gifts? What did you spend on travel? Even what did you spend on new outfits for those holiday parties, right?
Jeez.
Yeah. And then going forward, you know, kind of approximate where you want to spend it this year. So that's kind of where you want to go with your holiday budget, and then figure out how much you need to spend, what's the shortfall, and how much you need to spend and put away on a weekly basis leading up to the holidays.
Yeah, all right. I'm not buying any more ugly sweaters for these Christmas parties or these holiday parties anymore. I'm just going to ask a Dallas Cowboys fan if I can borrow one. Oh, zinger. Anyway, Jessica Perrone, thanks so much for taking the time here on the day.
Thank you so much for having me.
Her Financial IQ founder joining us here on set. All right, well, speaking of the NFL season kicks off next Thursday night when the Baltimore Ravens face off against the reigning Super Bowl champs, the Kansas City Chiefs. While that game will be nationally televised on NBC, if you want access to every NFL game throughout the season, it might cost you a pretty penny. Yahoo Finance contributor Ross Mack joins us with more. Hey, Ross.
How you doing, man? It's football season. I'm pumped.
We all are. I'm ready. So what are some of the costs that we should be anticipating this NFL season?
Yeah, well, here's the reality, right? Back in the day when I was growing up, all the games effectively were exclusive on cable TV, right? Cable channels. However, now it could definitely run you a pretty penny, largely because of all of the new partnerships that the NFL has with different streaming services, right? So if you truly wanted to watch your favorite team and maybe watch every game for all the 17 weeks, well, you're gonna see yourself looking into Sunday Ticket on YouTube TV. You got Peacock now, Netflix, Amazon Prime, and you still need cable TV, right? So for instance, out of all the games, roughly 15% of them are exclusively on streaming services. And so if you're looking at YouTube TV, that could cost you $167. Obviously, we got Peacock, call it at $7.99, Prime at $8.99, and the list goes on. But you look at and you can see yourself paying well over $100 just to watch your favorite team, except if you're a Colts fan. Unfortunately, luckily for them, they have no games on streaming services this year.
Okay, yeah, exactly. So it's a cost benefit for themselves. So now what if people are trying to get out of the house to watch some football, either at the stadium or even at a bar? I mean, is there an estimation of what that could cost people in those different experiences?
Absolutely. Look, inflation knows no limits, right? And that actually goes the same with actual tickets to a game, as well as the things you do while you're at the game, if that's grabbing beer, hot dogs, soda, the list goes on, parking, right? So you can find yourself saying the average NFL ticket has increased roughly 8.6% to about $121. So for a party of four, you're looking at roughly $630 or so. And the reality is, that's just not it, right? Say you want to actually just maybe go to a bar and watch it with your friends. We're seeing inflation there when it comes to the beer prices, et cetera. The average drink might cost you, I don't know, anywhere from $10 to $20. And so at the end of the day, we love NFL season, but you might just need to budget to be able to afford to watch all the games.
All right. You know what I'm going to say. Fly, Eagles, fly. Ross Mack, thanks so much for taking the time here today.
Bear down, brother. Bear down.
There you go. Appreciate it. We've got much more on wealth after the break. You're watching Yahoo Finance. Dollar General, Dollar Tree, and Kroger are charging you fees when you get cash back at their stores. Yes, you heard that right. You are paying more when you try to access your own money at these stores, and that's to the tune of tens of millions of dollars here. Now, the Consumer Financial Protection Bureau, they sampled 8 large retail chains and found those 3 are estimated to charge about $90 million in cashback fees annually. Now, each chain has cashback fees between 50 cents and $1, but the real amount the retailer pays for processing those transactions, just a few pennies. And according to these findings here, dollar stores are typically located in small, rural towns, communities of color, and low-income communities, and those areas are likely to have fewer banking options, so fewer places to withdraw cash without a fee, and that's thanks to things like bank mergers, bank closers for branches, and out-of-network ATM fees. All that together means these consumers are hit the hardest. So watch where you're shopping before you pull out your money as well on that end. Speaking of retail, a lot of more cautious consumers can expect some big sales from retailers this weekend for Labor Day. So what are the best products to shop for during this time and during this sales blitz? Here with some more insight, we've got Bridget Carey. She is the editor-at-large for CNET. Bridget, great to have you here on the show with us. All right, so what are some of the top flashy headline deals that you're seeing come across in advance of Labor Day weekend?
Well, I don't know about you, but my inbox is blowing up with it seems everyone has a sale suddenly. It's like giving Black Friday, right? But it's not that big, I will say that. You're seeing the end of summer, so it's the end of season sales on summer outfits, summer grills, yard tools, gardening. But also when it comes to tech, you're seeing sales on laptops, TVs, and as we're kind of seeing historically, it's always a good time for mattresses.
Oh my goodness. All right, cool. I might be in the market for at least one of the things on this list here right now. It's so interesting, especially as we're tracking some of those deals that have come forward and are hitting our inboxes as well. Is there a good time to buy for some of these Labor Day deals that we're seeing coming forward?
You know, I think if you see a sale, just kind of go for it, but also don't have too much stress in that you have to shop right now. This is a good time if you haven't bought that back to school gear yet and you were procrastinating on certain items. Okay, go pick up the tech that you need for school now, right? But, you know, when we start in October, you're going to hear about another Prime Day from Amazon. It's going to rev up again. It's going to feel like Black Friday is creeping in. So right now, if you need something for the home, you know, small home goods, you know, appliances, you know, go for it. You know, look around. What do you need now, and make the most of the sales that are happening now for the things you need.
Are there any unique deals that you're seeing or coming across that we typically wouldn't see this time of the year, or any abnormal deals out there that might catch some consumers out there?
You know, it's the smaller stuff you don't typically see, like car chargers, candles. They're trying to get you on the little things. We talk about sales. We're always thinking about laptops, but you know, board games also. You know, things for the family. You know, everyone's going back to school. Doesn't mean you have to stop playing board games. So you know, kind of get creative here and use the sales wisely, or stock up on Christmas stuff. You know.
So a lot of people are naturally have to work through this thought process of whether or not now is the time to buy Apple products here. What is your calculus that you're running around this?
Stay away from the Apple store, because there's going to be an Apple event soon in just 2 weeks. Apple's going to be revealing new gadgets. And so I would say if you're going for like a brand new phone, no, but it's a great time for a sale if you don't care about having the newest stuff, because retailers have to sell their inventory. So they're going to discount all the current earbuds and the other gear like old phones. Go ahead, grab the sale. If you don't care about having the latest iPhone 16, then yeah, it's a great time to buy, because yeah, they have to get rid of their old stuff before the new stuff comes out in just mid-September.
Even when it does come out in mid-September, should people be buying on the launch of it? We heard that there might be some delays in the generative AI features actually making it into the OS that's going to be going on the devices. How should people really be thinking about when is the right time to buy for some of those products that are going to be announced in September?
It's a good point. You know, a lot of us feel like, oh, if I don't get it right now, I'm not part of the cool club. Well, the cool club is going to be showing off their AI features, and they might not all be there at launch day. So you actually benefit. If you're someone who doesn't like to, you know, pull the lever and get the iPhone on the first day, you know, go ahead and wait for the reviews. You know, give yourself some time. Don't feel like you have to rush. But the prices aren't going to change. So, you know, it might be like a matter of a month where the coolest iPhone features come out in the software, but the iPhone will still be the same hardware.
All right. Well, I'm still on my 12 Pro Max as of right now. So I've been getting the nudge from our tech editor, Dan Halley, to go out and get my new phone. So maybe I'll have to wait a little bit, but I'll report back, Bridget, on the features. And I mean, you've got some great reporting that you already put out anyway around that too. Bridget Carey, CNET's editor at large here. All right. We're all going to try some of these new products here. Thanks so much, Bridget. Appreciate it.
Thanks.
Guys, coming up, we've got an episode of Stocks in Translation with Michael Gayed. That's right after the break. Stick around.
Welcome to Stocks in Translation, our essential conversation cutting through the market mayhem, the noisy numbers, and the hyperbole to give you the investment information you need for your portfolio. Today, I'm joined as always by Sydney Freed, my sidekick, and today we have Michael Gayed. He is the publisher of the Lead Lag Report, also a CFA. Welcome, guys. And on the docket today, we are going to be talking about the growing corporate risk in America, maybe an underappreciated risk. And our word of the day is concentration. Is it truly a risk? Spoiler alert, yes, it still is. And this episode brought to you by the number 81. That's how many days we have until Americans elect the next president. How much does it really matter to investors? Well, week 2 of the saga that began with the VIX hitting the mid-60s last week in the middle of a bull market, Japan blowing up in a big way, spilling overseas. How are you seeing the market today? This is about a week later.
Was that really like last week?
You know, it seems like ancient history.
Seriously, that seems like, yeah, it's like I feel like everybody forgot about that because everyone suddenly bulled up again. This is what happens when everybody's on the same side of the boat holding an anvil.
Yes.
All right. Everyone's basically bullish and of the same mindset as far as things will keep on rising and rising just because they already have. I've been highlighting this reverse carry trade idea since August of last year, which I know it sounds complicated, but the idea is very simple. Japan is, there's a monetary mismatch that's happened. Every other central bank has raised their rates except Japan's because they've never had to really deal with inflation. Here comes inflation. Now they're way behind the curve. Meanwhile, if you want to borrow money really cheaply, you don't need to do it by borrowing in the US. You can borrow from Japan because at zero rates, why not? So if everybody does that, leverages their portfolio based on Japan as the enabler of that leverage. If Japan then starts to raise rates, that creates a problem for you as the borrower, because now you're having to pay back that loan with a stronger yen as a result of that, and that creates volatility and, conceivably a global margin call. Now, you had a moment there when everyone freaked out. My own X account at Lead Lagaport got 14 million impressions because everyone knew I was the guy that.
Yeah, I got to say, you were blowing up. I follow your account as I have, and there was a lot going on.
It was a lot, yeah. It was, and I put a whole video out this on Sunday, basically, even showing that, which had 200,000 views, at least as we're chatting here. I don't think it's over. I think when these things take place, it takes time to work its way through the system. The carry trade is something that's been ongoing for years. You don't resolve that in 48 hours.
Yeah, we're going to let's circle back to the carry trade. I want to get to our word of the day, which is concentration, because it kind of relates to everything we're talking about. Market concentration can occur when only a few stocks in an index or portfolio account for most of the gains. Bull markets experience some degree of concentration in indices as some individual stocks rise in price, they rise in market cap, and therefore they make up a larger part of the indices, the pie. And the dynamic also works with individual investor portfolios. And we talk a lot about concentration this year in the form of the Mag 7, but it applies to a lot of different pockets of the market. I'm just wondering where you see it right now and where the risks lie.
It's actually, I think, a really interesting time in history in that it's debatable as to whether the S&P 500 is really a diversified index anymore, right? When you've got a select number of stocks that are driving the entire momentum play across the board. The reality is most stocks are still trading below their 2021 highs. So it looks like a bull market, but it looks like a bull market because it's really a concentration bubble where you have some of these large cap tech names driving pretty much the entire performance. That's worked if you're an index investor, obviously. The problem and the risk there is that now you're not playing the market, you're playing individual companies, right? And that concentration risk means you have much more what's called idiosyncratic, company-specific risk, which could become problematic, right? I mean, lay out any scenario. China invades Taiwan. What happens to Nvidia and what happens to the semiconductor trade? Maybe Nvidia actually goes up more, right? And becomes even more concentrated as a result, right? It could be, because now they're the only ones left standing. But the point is that it's not a good thing when you're at a point where a rising tide is not lifting old boats. I've used that line before on X. When a rising tide does not lift all boats, everybody drowns. There's always an aspect of the Pareto principle, 80-20, driving returns, a small number of things. But you're at a point where it's like the Pareto of the Pareto. It's like the 80-20 within the 80-20. Yeah. And I think that's not a healthy thing. I also think it's somewhat reflective of the economy, right? You only have a small number of participants generating all the wealth. Everybody else is still feeling like it's a recession. It's a microcosm of a much bigger issue.
Michael, did you say the word Pareto?
Yes.
That went right over my head. Can you explain what that is?
The 80-20 rule, it comes from this guy, I forget his name, but it's something Pareto. But basically, it had to do with the potato famine, as I recall.
Not what I expected.
No. But basically, it is that 80% of your returns come from 20% of whatever your mix of things is. So a small number of things are the explanatory variables, right, that go into an outcome. And you see that in a lot of things. There's always a small number of things that have outsized returns. But the smaller that number gets, the more fragility there is.
So going back to something you said there's debate about whether the S&P is diversified. Yep. So if you are an index-only investor, how can you further diversify away from those?
Good question.
Yeah. So the question is what is it about the S&P, which you can argue is a feature, not a bug, which is that it allows for this concentration, is that this is a market cap weighted average, right? So in other words, the biggest stocks get the biggest weighting in the average. There are a lot of ways to resolve that by looking at other types of indices which might be equal weighted, right? Where you're spreading out the risk across more stocks evenly as opposed to just favoring the largest of the large. You can also tilt smaller mid-caps, small caps. I do think there's a lot of opportunity in a large part of the marketplace which has lagged throughout the last 3 years.
Which is?
Primarily small caps and mid-caps. Small caps,
let's talk about small caps here.
So I've said repeatedly on X, small caps hold the key because part of the reason why I've been skeptical of this so-called bull market is the vast majority of stocks are trading below their 2021 highs because there's concern that these companies will no longer make it. There's the so-called zombie companies. They have very high leverage, razor-thin margins, and now they have to roll over their debt into much higher rates, right? Even if the Fed cuts rates by 25 basis points, 50 basis points, it's not enough
They almost need a recession, in which case they might go under anyway.
Right, exactly right. So they might go bankrupt, but at least they have a chance because rates might be lower enough at that point for them to survive. That's exactly right. But because of that, you can argue that there's this overreaction in terms of pessimism on the small cap side and overreaction in terms of optimism on the large cap side, the market cap weighted side. So the best way to diversify away from the S&P is either equal weight or do something much smaller in terms of your average, which of course means have more stocks. The problem is you do that, and guess what? You're not going to be that happy with the results because it sucked the last 3 years.
Yeah, so let's dig into some of the catalysts that we might see. We have CPI coming up. When we release this, it will actually be one day in the rearview mirror. But nevertheless, let's talk about what can move this market. And CPI, I look at reports, how much they affect the benchmark indices, and it is by far and away a much bigger mover of the market than the Fed or non-farm payrolls. What do you think is going to happen? What could happen?
It's very tricky, I think, when you look at inflation. So there's an argument to be made that inflation largely is squashed in everything except the stuff that matters, okay? Which is always the case, but maybe
food, energy,
the
shelter,
the stuff that nobody
education,
needs,
medical.
right? If you're fasting, you don't have to worry about that. That's why I don't feel inflation anymore. But I think it's so I have this sort of theme of mine, which is I think there are three sources of inflation post-COVID. Initially, it was the supply chain side of things, right? So we know the disruptions, everything got priced up because of that. Then it was the stimulus consumer spending. I think the other wave of inflation, which is still there, but primarily centered around the very wealthy, is asset inflation, right? Which is the stock market and housing. So the wealth effect, right? So to the extent that the S&P 500 and housing stay elevated, and the very wealthy see that and that makes them comfortable to keep on spending at the rate they've been spending, there's still going to be inflation. It's very high wealth, consumer-driven inflation. To the extent the S&P drops 15-20% and housing drops 15-20%, yeah, you're probably going to have a disinflation, deflation scare. But my point is that any sort of CPI number here that might come in a little bit hotter than expected is probably more because of asset prices, not because of something that is due to the Fed's lowering of rates or raising of rates.
Sid?
Yeah, I just have a question generally about when econ data comes out and stocks move one way or another. Like, basically, why does it move? Like, even when we got that weaker than expected jobs report, stocks tanked. There was also the yen carry trade. But then when we got the next data point and it wasn't, everything kind of reversed. Yeah. So how much can investors really rely on these data points? Or is it more that we should be watching general trends in the market as opposed to what inflation is telling us, what the latest jobs report is telling us?
The reality is most of the reactions have nothing to do with human beings. It's entirely machines that are and algos that are trading off of each other, off of headlines, because there's no way anybody can possibly read a CPI report, click a button that quickly, do it in size, and then move markets. It's all obviously very much driven by algorithmic, high frequency type of dynamics, which can be noise and can be gaming each other. It's machines fighting machines. So I don't know if there's much signal in that, right?
There's a great graphic that's about to pop up here.
I'm sure, yeah. It's going to be Terminator type style, right?
So I genuinely am curious about that. Is that how it works? Like, you get a print. Are there not just a bunch of individual investors all of a sudden selling stuff because it came in weaker than expected? Is that not how it works?
If they are, they're already way too late. I mean, I think that's the point. You're talking about milliseconds.
Yes.
Yes. Markets are supposed to be efficient because of the speed aspect, but not efficient to the point where it's like half a millisecond, right, where the price reacts that way. Because there needs to be an actual processing of the information to determine what trade you want to make.
The way I've always seen these reports is it gives the market an excuse to move into an area where there's going to be a large investor that makes a decision. You're just trying to go from equilibrium point to equilibrium point, and you're absolutely right. That doesn't happen in half a second. But I look at the close, like if you have a big payroll report that day, or if you have a big CPI report, where did we close? Was it good news being good news, or was it good news being bad news? And that, I think, kind of informs my own personal, direction bias. All right. We got to hold this thought for a second. And coming up, we're going to be talking about the presidential election and the outlook for stocks, plus an international edition of Who Wore It Better. Break out your sombreros and didgedoos. All right, we are back in this episode brought to you by the number 81. That is how many days we got until Americans press the mechanical and virtual levers for the next president. We talked last week with Ryan Dietrich about seasonality in these years, election years, but we've also cataloged on this program just how wrong the investing predictions were for Trump and for Biden, with the legacy energy versus clean energy trade 180 degrees what investor consensus actually thought. Then again, consensus is also usually wrong. So how do you see the election unfolding, and how much do you care who actually wins in November?
For markets, it can matter from a historical perspective in the sense that typically the market does better under a Democrat than a Republican, which is surprising to a lot of people because you'd think that Republicans would be more favorable for the stock market because of tax policy and pro-business. Part of that's maybe skewed by the 90s, right, to some extent. There is another implication in terms of who wins in terms of sector leadership. So typically when you have a Democrat in office, technology outperforms. Typically when you have a Republican in office, technology underperforms relative to other sectors. And Republicans tend to have the most impact on the raw materials sector, energy materials. The one thing that I think everybody can agree on, independent of your politics, is whether it's Trump or Harris or Kennedy or somebody that had parents that came from Mars and that alien is born in the U.S. and can then run for president, the commonalities remains the same. They're all going to add more debt to the system. Let's call a spade a spade. It's where they're going to direct it. It's a whole different issue, right? That matters so much more than anything else, given that we have, $35 trillion of government debt now?
About.
And yeah, roughly, right. I mean, in reality, it's much more than that when you factor in the unfunded liabilities. That, to me, is the more stressful thing, I think, to think through. I put a poll out on X asking who would add more debt to the system, Trump or Harris?
And what'd you find?
The interesting thing was 70% said Harris, which was actually fascinating to me because I think it would be more Trump, honestly.
Why do you think that was the response?
I think I think it's partly justified. There's a communication issue on the Democrat side that everyone thinks that they just spent.
Yeah, but it doesn't really matter. Is it one of them will add 500 billion versus 450 billion? Is it kind of like that?
It doesn't. Yeah, I think that's right. I mean, in reality, these are rounding numbers, right, for most of the things. But it goes back to you're never going to have somebody in office who will enact austerity, who will actually cut back on spending because you don't get elected.
They'd have to get elected on that mandate,
good luck.
And that's very unusual.
Right, good luck. I mean, that's never going to happen.
Is there a correlation between a clean sweep, say Democrats or Republicans get everything, the White House, Congress? Is there a correlation with how stocks do, or is it just the president under Democrats, the stock market does better?
Yeah, from what I've seen, it tends to be more on the president's side, not the clean sweep side. And that's kind of a relatively small sample on the clean sweep side, so kind of make, I think, broad generalizations. But the point remains the same. Everyone gets hyped about who's going to be president. Is it going to be good for the stock market or not? The reality is, for the most part, even though you will have a president claiming that they are the reason why stocks did this or that, the reality is it has less to do with the president, more to do with monetary policy and optimism.
You're an ETF manager. I want to ask you about some of the ETFs that you manage, and one in particular, JoJo, that's J-O-J-O, you believe is ripe for a breakout. Can you tell me, it's really interesting to me how these apply to risk-on, risk-off scenarios and how you would use them in conjunction with each other.
What is the risk that's off in the term risk off? Nobody ever defines because there's still risk in everything, right? The risk that's off is default risk, bankruptcy risk, right? It's why when you have a more traditional recession and high volatility juncture, credit spreads widen because the bond market starts getting nervous about some highly levered company being able to survive, right? Okay. You haven't had default risk in a long time, right?
Yeah, GFC maybe.
Yeah, GFC, and then you have some momentary scares, but we just went through the fastest rate hike cycle in history. Bonds got crushed, but they got crushed because of interest rate movement, not because of default risk, not because of a reevaluation of credit risk. And the name of that fund is the ATAC Credit Rotation ETF. I designed it for credit risk widening. and I happened to launch it right in the middle of 2021, before the bond bear market really started picking up steam, and before the duration crisis.
I've seen that happen with just about every ETF.
My
ever.
timing has sucked on launching funds. It's very clear between my RORO ETF, Jojo ETF. Even
Well, you're
ETF.
subject to the whims of the SEC too. It takes a while to get these things through.
Yeah, and also, correct. And also, it's one of those things where if you're going to try to stand out against Vanguard and BlackRock and all these other very large companies, you've got to develop a different type of product, right? This is from a business perspective. In my case, I need a very particular cycle. I need a cycle where there's risk. And when I go back to risk off, I need a cycle where there's default risk. So I would not mind seeing a recession. I would not mind seeing default risk rising, which is more normal than what we've seen the last 3 years. And if that's the case, then hopefully my funds have a chance, because I need the environment to favor them for them to stand out.
Michael, going back to our diversification question, in terms of you said, Jojo, it's a bond ETF. How much do you think should be correlated in an average investor's portfolio, stocks to bonds, maybe a couple alternative assets in there?
So I'll flip the question a little bit, and I'll say, as a general rule of thumb, the definition of diversification is you have things in your portfolio that you hate. You have to have things in your portfolio that you hate, because if you hate your
They usually have the lowest prices.
Yeah, right. Well, exactly right. Because why do you hate them? Because they're not performing. I mean, diversification has to mean that if everything's firing off in your portfolio, you're clearly not diversified.
We got to redo the definition of diversification.
Yeah, it's not,
we have an entire green screen.
Yeah.
No, right. Put hatred right on the screen. But I think that's the point. It's like, you have to have things that you don't like because they're not performing to be diversified. Now, how you weight them is a whole different issue. I get that, right? But broadly speaking, going back to the concentration bubble in the S&P 500, you're definitely not diversified in that one proxy for, in quotes, the market. Most people still hate bonds. They probably shouldn't, because the time to buy something is when everybody hates it, and everybody still hates bonds. Alternatives do make sense broadly as diversifiers, gold in particular among them, because it's not correlated over time. I think that's why it's doing quite well. There is a demand out there for non-correlation. And the thing about diversification, true diversification, is you're going to have years where you're doing okay and years where you're doing okay, meaning you're never going to be exceptional and you're never going to be collapsing. And that's okay.
With that, we're going to start in today's Who Wore It Better? And we're venturing beyond the borders of Hollywood, a bit south to the land of Mexico, where we find the Mexican peso recovering from a beating, down 25% since rebounding 10%. That was 1/4 of its value wiped out in weeks, a huge amount in Forex land. Then we cross the equator, travel halfway around the world, and land in Australia, where the Aussie dollar has been roughed up, down nearly 18%, then whipsawing 9%. It's not just how big the numbers are. Who is wearing the yen beating better among some of these higher yielding emerging market economies?
It's a very good question, and I don't know if I'm not big on fashion, as you can tell. Right? So I don't know if I can answer who wore it better. But I think what you're hitting on is something which is important. Healthy global systems do not have volatility like this. In Forex, in currencies, where people forget it's not just about the Aussie dollar and the yen. This is what people use to transact
Multinational
globally.
Corporations use this. I mean, this disrupts their planning efforts in a big way.
How can you possibly know how to hedge or how to think through your revenue if you're an exporter, if in a single day you can have a disruption like that? Think about how that reverberates over time in the actual fundamentals of every single company that's out there. That's why I keep going back to none of this can possibly be over, because we haven't seen the butterfly flapping its wings ultimately creating the hurricane. It takes multiple rounds of that to filter through in a chaotic system. So, listen, I mean, it's true that stability tends to breed instability. I think we're at the very start of that birthing process.
At the end of the month, I wouldn't be surprised to learn of a broker kind of scrambling for credit. Depends on how things evolve. But
I have no doubt. This is what you see, actually, is you end up not hearing it as it's happening, but there's probably some firms that largely have blown up.
It took a few weeks for Melvin Capital to make
Right,
this.
exactly right. And it goes back to there's always lags with this stuff.
I have a very basic Forex question for the two of you. Currency. You know how you say like the dollar is up against the yen? Could you ever say the yen is blank against the dollar? Like, how do you flip these things?
Because of the convention.
Yeah.
Which is first? I mean, that goes back to the 1970s. I don't know if you have thoughts on this, but basically that's the way it's been done for a long period of time. And you look at the order, it's the euro versus the dollar, not the other way around, but it used to be the Deutschmark versus the dollar.
Right.
Your thoughts?
Yeah, I mean, part of that's just, I think, reserve currency, and us being egotistical Americans.
That's what I was thinking. U.S. has to come first.
Right.
Well, we want to get a little personal.
Yes, we do.
So you are a musician.
Yeah.
I want you to talk a little bit about that and how it compares to working in the stock market a little bit. It doesn't at all.
Recording a studio album.
It's funny. I was actually just interviewing a guy who, in the 80s, was part of a pretty big band. And I asked him that question. I said, as a musician, I forget who said it. I think it was Stevie Wonder who said it. He said, there's only been one song ever written, and every single musician has their antennas up picking up just a piece of it. I think that's kind of roughly the quote. And the point of that quote is that everything has a progression and is fairly repeatable. And you can make the case that is the case with markets as well. There are cycles, there are progressions that take place, which they sound similar to prior songs and they rhyme. They're not exactly the prior song, right? I started being a musician in college with guitar because, like every other young man at the time, I was trying to impress ladies. Clearly, that did not work. And wrote a few songs, put an album out in 2020, 2021. It's more of a.
You did that in the middle of the pandemic. I mean, were you even allowed to be inside and congregate at that point?
So it was interesting. I had a bunch of songs I had written, and I still had the original WAV files, which sound absolutely horrible. I hope to God they're never released. But I had a producer, right, that I found from a website, and hired a bunch of session musicians, and here we are. I use them instead of other music because I don't have to pay licensing fees for my shows.
Fun fact, you lost nearly 100 pounds.
I know, well,
You lost 100 years.
Wow, there's a
Benjamin
Freudian
Button.
slip.
Yeah.
All right, Britt Van Winkle here. What is it? All right, you lost 100 pounds over a year by fasting and through exercise. Tell us about that experience.
I turned the page on my life because I started saying to myself, if I don't do it here, I'm not going to do it later.
Sure.
It's funny because I think where it really started, as I recall, was I started seeing ads for intermittent fasting randomly on X, and then I started getting YouTube algo pushes. I started watching them. It's like, all right, this kind of makes sense. My brain tends to operate in very much a to-do list type fashion. So it's like, all right, if I'm going to fast, it means I have one meal a day. Okay, check mark. Now I'm done. I can do other things. Started getting into the science of autophagy. Started learning about supplementation. Basically, started targeting every single week. I need to lose 2 to 3 pounds. I don't deny myself when I eat. The fascinating thing about fasting is that you can actually eat whatever you want.
No, I didn't know that.
But you end up naturally favoring higher protein because you realize how much more protein you need when you're fasting. But it's been funny because I never intended for it to be a thing on social media, but as I've been sharing it, so many people are now saying, you've inspired me to fast, and then I joke that the stock market's going to go through its own fast, as if I'm right about this carry trade. But some people think it's a fad. And I go back to, if you think it's a fad, please say that to Jesus Christ.
All right, good point there. And we got to leave it there. We have wound things down. And thank you for joining us. Michael, as always, Sid, we're going to leave it there.
Let's do a final check of the markets as we are approaching the lunchtime hour on the East Coast here and taking a look at the Dow Jones Industrial Average, the S&P 500, and the Nasdaq Composite. We are down across the board right now. 0.3% in the red for the Dow, 0.6% for the S&P 500. The Nasdaq tech-heavy average down by about 1.1% here. That's it for Wealth. I'm Brad Smith. Thanks so much for watching. Stay tuned for Market Domination with Josh Lipton and Shauna Smith coming in at 3 p.m. Eastern Time. They'll count you down to and through the market close. Plus, they've got Nvidia earnings later today. You don't want to miss it.